broadly speaking, the economy has been extraordinarily resilient to very high interest rates.
It just feels like this market needs to stop, pause, have a little moment of digestion and catch its breath.
It seems like we're getting to the end of the Fed tightening cycle.
If we are getting inflation sustainably back to 2%, that has to happen with some kind of contractions.
There are signs that certain parts of the economy are reaccelerating.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 negative by 0.4%. More downgrades a week since the last set of downgrades. This time not on the sovereign, on US banks, Tom. 10 of them. Downgrades from Moody's overnight.
Well, that's a bank story here. There's a bank story in Italy as well. And I guess, that's sort of the economic thing to look at. But overwhelming everything here this morning, led by the news out of China, it is Deflation Tuesday. There's no other way to put it. I'm looking at this screen, John, and I haven't seen that screen in 4, 5, 6 years.
Trade numbers dreadful. Exports, imports, take your pick your region. Dreadful.
We were out front of this story yesterday, and John, I'm going to repeat it again. Instantly, there's deflation in the air. I can bore you with 8 ways to go here. It doesn't matter right now. All you got to do is see even oil breaks down.
Every single time we get some data, Lisa, out of China, it's downside surprise, and the trade data, no different.
And this is one interesting area. You can see that the divergence between the U.S. and China has been accelerating. And what you have seen with respect to the U.S. dependence on China is it's decreasing, even though in Europe, it's not. And so, again, I wonder how much those stories are linked. The underperformance of Germany and the outperformance of the United States.
I'm going to bring it right back to where you started, John, is the banks. The banks have to deal with this disinflationary deflation tendency. And I think you're going to see that. You've got some quotes I know this morning here from some of the bankers trying to figure out soft landing or that. But with this deflation overhaul, I wonder what it means not only for the big banks, but for the SVBs we've all forgotten about.
Mark Oklanovic pushing back over at JP Morgan, as you might expect, against the prospect of a soft landing. Pushback from Moody's. I think Moody's just turning up the volume once again on a conversation we're already having. Higher funding costs, the smaller banks in America, potential regulatory capital weakness there as well, and rising risk tied to commercial real estate, Tom. They're all known knowns, aren't they, in many ways? There's nothing new there. But just like Fitch last week, it just turns the volume up a little bit on a conversation people are already having.
To me, this is a bigger deal than Fitch. Fitch, I get, and there was an uproar, and Secretary Yellen and others got all mental about it. This is just, here's where we are. We've had a 2023 of surprise and shock, and all of a sudden there's this global deflationary tendency. Who looks good this morning, looking at the launch pads, the IMF with that cautious 5-year view that they gave us months and months ago.
Do you want the look on UPS right now? Revenue, $22.1 billion for the second quarter. The estimate, 23. So that's a slight downside surprise. EPS for the second quarter comes in at 254. The estimate, 250. The outlook, listen to this. They now see the full year revenue outlook of about 93 billion. They had seen about 97. The estimate was 96.63 billion US. So that is a downside surprise, Bramo. That stock is negative too. We're down by 2.61%.
It's not entirely surprising, given what we saw with Uber and the freight services, given what we've seen on the peripheries. But there is this larger question, and it goes back to whether we're dealing with disinflation or deflation, this concept of when do goods and services meet? Goods, you can see there is this slowdown, there is this recession that does persist, and people are not sending around as many packages. On the flip side, services keep going gangbusters. At what point do we see some sort of convergence? And right now, it seems like goods are still on the back foot.
We'll come back to that a little bit later. UPS negative in the pre-market by a little more than 2.5% this morning. Equity futures on the S&P 500 negative by about 0.5% on the S&P. Yields all the way in, down 9 basis points on a 10-year. It's a break of 4%, 3.99. Lisa, 3.99.59 on a US 10-year.
We were talking about trade, and we do get some trade data at 8:30, but I'm actually more interested in some of the Fed speak. Philadelphia Fed President Patrick Harker, who speaks around 8:15 a.m. Richmond Fed President Tom Barkin around 8:30 a.m. To me, the key data point of the day are some of the metrics underpinning the auction at 1 p.m. The U.S. is planning to sell $42 billion of 3-year notes. This is the first of 3 auctions that consist of the $103 billion that the U.S. Treasury is selling, up from the expected $96 billion. If these go well, does that fuel a risk on kind of move? If these go poorly, could this determine the risk off kind of feel for the rest of the week? And today, earnings continue. Lyft, Rivian, AMC, Bumble, Duolingo, iRobot, all of the ones that we know and love. I find it interesting. How much do we see consolidation among the big winners? Lyft shares lower by 0.5% so far this year. Uber shares up 82%. Rivian, the electric vehicle maker, up 31%, 32%. Tesla up more than 3 times that. Do you see that ongoing consolidation, or do you see some of the second runs, the runners up, I should say, really make a push for it?
The day ahead from Lisa. Lisa, thank you. That's the day ahead. The earnings coming out a little bit later. Dean Kernick joining us now, founder and CEO of Macro Risk Advisors. Dean, great to catch up with you, sir. Looking ahead to the issuance coming out through the week. Lisa mentioned today the 3-year, Thursday the 30-year. It's going to be a big focus for a lot of people in this fixed income market. Do you see any problems on the horizon, Dean, taking down that additional supply from the Treasury?
Certainly difficult to know, but it's a theme that's come very quickly within the market's crosshairs. Let's just step back and look at the 2 steepening episodes that we've seen, that sort of disinversion episodes that we've seen this year. The first was March. That was SVB. That was really all about the front end, right? We had a gigantic move higher in the move index, the VIX, for rates. Short dated rates came down a lot. This is different. This is really the long end. And I think there's a confluence of factors. It's Fitch, which is a kind of a Captain Obvious moment. We know the U.S. is on an unsustainable path, but it doesn't help to hear it. And Janet Yellen's protestations aside, everything that Fitch wrote is kind of spot on. And then you point to supply. So it's going to be interesting to see the ask of the folks that have to own this paper to buy it at a time when, the price momentum and the trend is higher in yield. And you also just referred back to the banking system. Banks don't work well in a deeply disinverted curve. And, one way to uninvert the curve is to have the long end rise, but that doesn't really help either. You're going to have maybe not SVB-like implosions, but folks are nursing losses on long end paper, and the backup in long end yields doesn't help.
I like the idea of nursing losses. Let's look out forward 1 quarter, 2 quarters, 3 quarters, Dean Kernick. What I see is a linkage here of less volatility, a quiet in volatility, and suddenly a quiet in price change of deflation. Forward, how do you play? What do you do given less volatility and less price change?
Yeah, it's a great point. And that's, I think, been a theme that's persisted for most of the year, which is, again, post the SVB tumult, markets really settled in. We're talking about realized volatility levels in the S&P consistently below 10. Those are not the dreams that long option holders are made of. It makes it very difficult to pay premium, even as the VIX came down to 13 or so. It makes it just very difficult to expend premium. And a lot of what's going on here underneath the surface of this low volatility is this profound decrease in correlation among stocks. You had the correlation of stocks in the S&P reach 8%. Just look at Friday. The NDX is down 50 basis points on a day that Apple's down 5%. And you can just look at it and say, okay, well, Amazon's up 8%. You shouldn't really count on that kind of offset. And so one of the things I'm just a little concerned about is this gift of diversification that's just been very powerful. Again, the zigging and zagging of stocks is a testament to the power of diversification, but I don't think you're supposed to count on it that much. And I also want to step back and just comment that prices can just be so disparate versus, the ultimate realities. And for Apple, for example, this $3 trillion stock, obviously everybody's got to own this thing. The cost of hedging Apple stock out 1 year, so fully 1 year's worth of insurance got down to the lowest of all time just before the earnings. Wow. And so you had this opportunity to insure the stock at an all-time high with the insurance cost at an all-time low. And I can tell you that nobody did it. No one wants to expend premium when things are going so well. So, our focus is really to try to understand this low correlation, pay a lot of attention to the back end of the yield curve. That's definitely a concern. And then, of course, watching the development of inflation metrics is going to be critical as well.
You mentioned the yield curve in relation to banks. You also mentioned the post-SVB reality of VIX going way down, although during the SVB meltdown, we did see a pickup in implied volatility. How much do you see this sort of ongoing grind in the small banks, in the regionals, as John started the show with, this idea that Moody's is downgrading names that are staples, PNC even put on watch for downgrade, Bank of New York Mellon, U.S. Bancorp, some of the staples of the regional banking market. We're really just across the board still seeing risk there.
Yeah, I'm certainly not an analyst for small banks. I will say that ratings agencies are often criticized as being kind of last to know and so forth, but sometimes they can catalyze an observation that something is wrong from a business model standpoint. And, you know, as the Fed has gone through with this tightening cycle, I think the most basic view has been, okay, they're increasing the cost of credit, right, just by raising interest rates. But there's also a supply side, and the supply channel gets kind of broken when yield curves are this disinverted, and the cost of acquiring the deposits that ultimately get lent out are this costly. So the supply of credit, I think, is worth focusing on a lot. Again, you're nursing losses at the long end from paper you bought in 2021 at extremely low yields. You're trying to ride it out. You've got this hold to maturity bucket, but it doesn't make the ability to supply credit very easy. Right. So I think that's part of potentially the Moody's downgrade as well.
Not everything's going to go down. Where's the opportunity right now?
Yeah, look, I think at the end of the day, you know, stocks do well in the long run. And what you're trying to do is just keep yourself exposed to risk, you know, in a broad, diversified way. Sadly, the S&P has really become much less of a diversified index than it has been historically. 28% of the index is comprised in the top 7 stocks. So that's something you've got to take a look at, you know, and just find a way to weather the storm. And to me, cash can be king, especially at 5% yields. So it's some combination, some mix of stocks and bonds to keep you in there. And I think, again, the risk is low volatility feeds into how you size your positions. You get too big at the wrong time. So our recommendation is, again, nothing that's earth-shattering. It's just to try to stay involved in the market. Don't get out of the market, but utilize the fact that cash has got a lot of optionality, especially at 5%, to stay in.
Hey, Dean, thank you for the update. Dean Kerner there of Macro Risk Advisors. Let's just get back to UPS quickly.
Yes.
Stock is down by 7.5% in the pre-market. It's a cut to the outlook, TK. And they're blaming one thing, aren't they? They're citing it directly.
Well, yeah, the Teamsters. Here's the headline, folks. It's simple. We made a union agreement and it's taking it right out of revenue, and they're going to adjust as they go. That's a one-off adjustment, John. I get that. But the question is then forward from here, how do you create revenue growth? And what I would suggest, given deflation and given the gift we've had of a boom nominal GDP economy, people that have been growing at 8% are going to start growing at 5.5%. People that are growing at 6% are going to go right back to that moldy 2-3% revenue growth of before. And you're going to see that adjustment forward here. Yeah, granted, it's after earnings season, but with UPS, with FedEx, and with Home Depot and the others, you know, we're going to see this, the revenue dampening is going to be there, whether it's Teamsters or not.
We're seeing that in the outlook this morning, Lisa. The stock is down by, let's call it 6% now.
Which raises questions, who's next? If Teamsters wants to go after some other companies, and it raises a question whether this is a template. The earnings need to go more to the workers in order to make the unions happy, and we have seen that consistently. How far can they push it? And how much does UPS get beaten up in terms of what it can invest in going forward?
They're supposed to raise prices. That's the theory. You know.
Yeah.
That's the theory. They got to raise prices 3%, 5%, 8%, whatever.
I always expect you to say something more than what you say sometimes.
I think this is really important. I'm glad, John, you went back to UPS.
Then I start talking and you just
logistics is a big deal.
Talk all over me. Vicky Chatter at Deutsche Bank in the next hour from New York. This is Bloomberg.
I supported raising the federal funds rate at our July meeting, and I expect that additional increases will likely be needed to lower inflation to the FOMC's goal. I'll be looking for evidence that inflation is on a consistent and meaningful downward path as I consider whether further increases in the federal funds rate will be needed and how long the federal funds rate will need to remain at a sufficiently restrictive level.
We've talked about this a few times. There are two phases to this. Phase one, get rates up really quickly. Phase two, sit there and hold. And Michelle Bowman doesn't think maybe we're done with phase one. That was the Federal Reserve governor. At least one official still looking potentially for more hikes later this year. From New York City this morning, good morning. Here's the equity market, the price action. Stocks down here by 0.4% on the S&P. Some downgrades of US banks in the mix, which we'll discuss throughout this morning. And some misses out there as well. UPS cutting its outlook for revenue. The stock is down by 5.6%. That's recovering just a touch. This from Reuters going into earnings from the Walt Disney Company after the bell on Wednesday, so tomorrow after the close. This according to Reuters, Disney creating a task force to explore, guess what, Tom? AI and cut costs. I think the cutting costs are the more interesting part of this. Where is Bob Iger and the team going with this? What is getting sold over at the Walt Disney Company?
MBA 101, if you see the phrase task force, duck or run or do both. I mean, it's Task Force Tuesday. John, I'm going to suggest you're going to see a lot more of this coming out here. There's going to be a task force here, a task force there. Task force are just big committees, I think is how you put it. I'm pretty cynical about it. All the triumph of Disney, Mary Poppins a million years ago, celebrating Sound of Music. You think Sound of Music was put together by a task force?
I didn't know that was Disney.
Oh, yeah.
I didn't know
The Hills
that.
Are Alive with the sound of a task force.
With the sound of Disney and
a task force.
Oh. You don't sound impressed by this task force.
I'm not. Task force is one of my least favorite phrases. Task force.
There are some interesting things that could come out of a task force. They've been looking for a strategic partner for ESPN. What does that mean? When does that transpire? Does that mean a wholesale sale? And it also highlights that content is king. That died. And that is sort of the new reality that we're facing.
Yeah. We're seeing some markdowns this morning. Joe Feldman over at Telsey Advisory Group looks at big box, what we're looking at with UPS and Home Depot and the rest. He marks down to market perform. Moments ago, Oliver Chen at Cowen took a dim view on Nordstrom and others. A lot of that's percolating. John, my data point, we didn't mention it at the top, the 10-year real yield with a vengeance from 1.80 down to 1.58. I believe that's deflation in the wind.
A nominal yield right there at 4%. I can't give you a quote from that movie, but 399.99 on a 10-year right now. We're down about 9 basis points.
We break 4,
in the Treasury market.
Yeah, there we go. Politics. Washington, amid all this unsettlement within finance, there is unsettlement in our nation's capital. Terry Haynes joins us this morning for a brief. He's with Pangea Policy, of course. It's August, Terry. The doldrums in the global world, it's in that China has a legit slowdown, and all of that export and import dynamics with China falls over upon us. What should be our to-do list to repair our trade dynamic globally, and particularly with China?
Well, firstly, we're going to have to continue. The United States is going to have to continue its efforts at diplomacy and be helpful. Secondly, I think the United States is going to have to be a whole lot more aggressive about trying to figure out what kinds of trade alliances it wants and with whom, not only in the Pacific, which is talked about a whole lot, but also enhancing its trade deals with both the European Union and the United Kingdom. And, the United States has been a disappointment on all those fronts. Basically, nothing's happened in trade policy substantially for 2.5 years.
Terry, you've been a student of this. What is the character of our isolationism now? I'm going to suggest maybe that's led by the Republican Party, but I'm sure there's a lot of Democrats that agree as well. Is our isolationism now entrenched and similar to what we grew up with as kids?
Oh, no, I wouldn't call it. I'll attack the premise a little bit. I wouldn't call it isolationism as much as I would think of it as, kind of not sure exactly how to engage. The free trade era was kind of over even before the end of the Obama presidency, even if a lot of folks in markets and elsewhere didn't see it. Certainly politically that happened. The question is really kind of how to engage and what the most constructive way forward is for the United States. We haven't seen any efforts politically on that really in about the last 6 or 7 years. Even the renegotiation of the Canada, U.S., Mexico agreements turned out to be basically a reshuffling of the deck. Welcome in a lot of respects, but still a reshuffling.
There has been a big shift in trade geopolitically, and we have seen the U.S. pull back from Chinese purchases. There is a question domestically about how much debt is sustainable, and this comes in a week where the Treasury Department is going to be selling $103 billion of U.S. debt. People are concerned about this. Is there any realistic conversation in Washington, D.C. about how to deal with the glut of sales and debt at a time when interest rates are going up?
Very little, I think. What we have here is a generation where a generation of politics where the received wisdom has been keep the status quo more or less from year to year on the top line federal spending. Continue to support the massive indirect federal guarantees, whether it be on housing, healthcare, anything else, and hope the problems go away. Frankly, but there's very little of that going on. Even what you hear from kind of conservative Republicans this fall, which will be part of what causes, I think, a likely shutdown of the government in the fall, is some sort of willingness to deal with that. But even then, what you've seen is the limits from people like McCarthy and Biden, where they'd like to talk about keeping domestic spending as a status quo, and maybe dealing with defense in a little bit less expansive way. At the same time, you've got all these geopolitical challenges, and you've got a consensus in both the Democratic and the centrist Republican parties that don't want to change anything. So that's a long way around to say, no, there's really nothing that's going to change about that in the short term.
Just to underscore what you just said, even though you think there is going to be a 60% chance of a government shutdown later this year, you don't necessarily think that will yield some sort of fiscal restraint in 2024.
Not meaningfully, no. I mean, even the most conservative Republicans talk about the starting point of fiscal restraint being a cutback to fiscal 2022 levels, which is a welcome first step, I think. But at the same time, that's a tiny step. You're not going to see anything seismic at all.
Terry, wonderful input as always. Everyone's a hawk until they get into power. It's a story of the last 20 years, isn't it? Terry Haynes of Pangea Policy. Terry, appreciate it as always. UPS, just an update on that stock. We're down here by 5.6% for UPS. An update on Apple as well for you. 5-day losing streak. Really tough stretch for Apple at the moment. It's down about 9% over the previous 5 days. Tom, we're just about positive this morning by 0.25%.
Two Apple things here. First of all, they are through 2 standard deviation. A lot of these pullbacks are very contained. I can't say that about Apple. Apple's clearly through the 2 standard deviation level. Also, our Mark Gurman has a rip-roaring Mark Gurman best-in-class worldwide note this morning on where they're going with M1, M2, and now they're going to roll out M3 for the laptop, John.
These are the chips, right?
These are the chips, the brain. Ex-Intel, building their own chips, M1, M2, John needs. And the offspring, Lisa, both of them, M3 laptops coming to a house.
How expensive
near you.
are these?
It can be outrageous. They're outrageous, and the reviews are mixed. I'm telling you, the new Mac Pro, the fancy, recording studio computer, got reamed in the press. I mean, there's some product challenges here. Not to make light of it, not to be the fanboy.
The stock is positive at the moment, going against the grain of the last week, that's for sure. We're positive by 0.3%. Rabina Faruqi of High Frequency Economics joining us shortly. On the road ahead, CPI on Thursday, PPI on Friday, bit of Fed speak in between. Harker, Barkin later on today. From New York City, this is Bloomberg. Snapped a 4-day losing streak on the S&P 500 in yesterday's session. Your equity market this morning looks a little something like this, with equity futures negative by 0.5% on the S&P, down about 0.5% as well on the Nasdaq. Lots to talk about on the UPS side of things. That stock negative by something like 5 to 6% through this morning so far, cutting its outlook for revenue, blaming Teamsters and union negotiations for some of the volume issues there. We'll talk about that later. In a bond market, 2-year, 10-year, 30-year, it looks like this. 2s versus 10s, negative 73 basis points at the moment. Only 2 weeks ago, that was negative 100. A lot of that lifting, the heavy lifting, has come from a 10-year yield that drifted higher, back towards 420. In the last couple of sessions, it's come back in. We're down about 9 basis points this morning. It's a break of 4%, Tom. It's 399.59 on a 10-year.
It is. The data is important. And again, I'm looking at the 10-year real yield as the key, sort of the linchpin of looking at equities, bonds, currencies, commodities. I got a 1.58 right now. We're disinflating, we're deflating. John, we got to take 3 seconds here. Would you please explain the American audience? This would be as if Aaron Judge of the New York Yankees or Ohtani out with the Angels was somehow being transacted. Harry Keene, this is the day they're meeting once more.
Well, how many deadlines have we had?
Yeah, well, this is it, I guess. And the Harry Keene transaction right now is deflating. They're talking about 100 million euros. Does he get that money?
No. Tottenham get that money.
Explain that. For Americans, that's completely foreign.
Well, if you've got a contract, you're an asset of the football club. Or some people might say a liability. And you can sell them. You can sell them for money. And you get the money for that player. Then the player negotiates what their contract might be, 3-5 years, and you get paid weekly. That's how it works.
We had a legal case 40 years ago, Kurt Flood of the St. Louis Cardinals, which we did away with this basically, where you weren't owned by the club. You were free and individual contract. What does Harry Keene want here? How does he walk in the Tottenham locker room if they deny him his move to Germany?
I think it's going to be really difficult.
I'm fascinated.
Another year left potentially, and then on his way for nothing. How many years has he got left? 12 months on his contract, Tom, I think.
I don't know.
12 months.
Baffled
by the potential that he leaves for nothing, which is the same kind of situation that Kylian Mbappe's in as well.
What would Adele do?
What would Adele do? I don't know.
I don't know.
Would she take
Adele's,
the money?
She's in charge.
Would she take the money?
No, I don't know about the money, but she'll get him.
This is not about the money. He wants to win, and he's not winning at Tottenham.
Yeah. There you go. It's your football update today with John Ferro, our Premier League expert.
Totally unprepared for that. Under surveillance this morning, prepared for this. Moody's downgrading 10 small and mid-sized US banks, citing a dimmer outlook. The rating agency saying the following: rising funding costs, declining income metrics will erode profitability. The first buffer against losses. Asset risk is rising. How many times have we talked about this, Tom? In particular, for small and mid-sized banks with large commercial real estate exposure.
They mentioned 10 banks, John, 20 banks?
10 banks.
There's like how many, Lisa? 2,000?
More an outlook.
3,000?
Negative watch,
What's
Lisa.
next?
Well, and then how much does this sort of crystallize a feeling that already is percolating out there, or maybe isn't? And this is what's interesting. It's off the radar of everybody. This hasn't been something that people have been paying attention to. The banking crisis is over. And now you're seeing those shares of some of the companies that were named by Moody's drop by more than 2% as people game out what this means for their borrowing costs and what this means for their reputations.
I said this about Fitch last week in a Sovereign. It just turned the volume up on a conversation. You get the feeling it does that again this morning, Lisa, around the US lenders.
And at what point does that consolidate some of the data that we're seeing where credit really is being withdrawn? Although, that said, we were talking yesterday about that credit report that was coming out at 3 p.m. and everyone was talking about, credit card debt, revolving credit. Turns out people are taking out more fixed rate loans like auto loans and mortgages. So go figure, because they're still getting them and they're still looking for them.
Elsewhere in China, weakness once again. The economic recovery just not showing great signs of strength whatsoever. Trade plunging, exports dropping over 14% year over year. The worst decline since February of 2020. And the regional breakdown, you go through some of these countries, Tom, it's like double digit down.
1/5, 20%. It's just a basic idea. John, what I would state here, I think it's important, a single sentence buried in most of the articles is global trade. Clearly, China is a dominant part of that. But this is not just about China. It's about, I learned this, frankly, from guys like Ken Rogoff and others at IMF, Olivier Blanchard. The basic idea here is everybody's got this country story, that country story. You know what? You sum them all together, is global trade off the ebb here, which is something that some have predicted.
One caveat. And this was in our story this morning. It's worth a read. The value of crude oil imports fell more than 12% in the first 7 months of 2023 from a year ago. If you look at the volume of crude oil imports actually jumped by around 12% in that time. There could be a slight commodity effect in all of this as well. Lisa, the thing that jumps out for me always with this kind of stuff, does this speak to a global economy that's not doing well or Chinese consumption that's underperforming? Do I focus more on the export number or the import number?
It's a great question. I don't know the answer to that, and it speaks to the Adam Posen idea of long economic COVID, that seems to be what China is suffering through. They're not just coming back to some of the spending patterns pre-COVID. At the same time, the Census Bureau put out this data in the past couple of weeks that U.S. imports from China were down 24% in 2023 from the same period a year ago. Guess where they're not down? In Europe. So you're seeing it really decline in the U.S., but not in Europe. So how much is this really specific trading partners pulling away?
I wanted to squeeze in this last story on Italian banks. They're down. UniCredit. Pick your bank this morning over in Italy. Look at UniCredit down 6.7%, Intesa down 8%. Elsewhere, stocks down by something like 7.5%. The government's proposing a 40% levy on windfall profits. Basically a windfall tax. Right. The tax could reportedly bring in something like 2 billion euros. The government blaming ECB rate hikes for the surprise announcement, which is somewhat controversial because I'm sure the banks would be blaming low ECB negative interest rates for the last 10 years for low profits, and they might want a rebate on some of that, Lisa.
I couldn't make sense of this. They didn't release any official wording or guidance. 40% tax on excess profits, blaming the ECB because why not? This is the populist government in Italy. What does this end up leading to? I mean, does this end up leading to actual policy with a 40% windfall tax, or is this basically a shot across the bow to shore up populist energy?
John, you know this cold. Is there a Chase? Is there a Bank of America in banking in Italy?
UniCredit is one. That's like a universal bank.
So what do they want? If they're leading the charge on this,
I imagine they're very upset by it.
They're going to get this surprise tax.
As Lisa pointed out, this can change in Parliament. This can be challenged in the court. There's very little detail here. The objective here is to try and raise tax revenue to help address a cost of living crisis, to do something about first-time buyers, to do something about people struggling at the moment.
Really? You think it goes right down to that level?
Without a doubt. That's what this is all about. It's a cost of living crisis in Italy and raising the tax revenue to address it. Now, if you believe these banks have made money purely off the back of interest rate hikes and not because of anything they've done with their business model, then the argument would be that you should levy a windfall tax on them. This is a one-off and they shouldn't reap the rewards of something that's come from the ECB. That's going to be the argument. Other people might say, look, they've suffered for 10 years because of ECB having negative interest rates, and finally we're getting positive interest rates. Why wouldn't they make more profit, Lisa?
And other people might say, wouldn't it be nice to have a resilient Italian banking complex that actually could survive through the next crisis? I mean, if you want to put provisions on trying to shore up their balance sheet or something like that, I understand. Just to say, we need taxes, you have money, let's take it.
That's always the way. The Thatcher government did this back in, was it late 80s? I think it was.
To show how fictional this is, and I'm not going to bore people with the math this morning, but with David Folkert's land out in London, I calculated out where Italian lira would be versus euro.
Oh, yeah. Where?
Way weaker is the fancy math. Way weak. Unbelievable, the weak euro that Italy needs to prosper.
Are we talking like 5,000 lira?
I don't have it in my head right now, but the answer is it's not like a nuance. It's like way weaker. There's under surveillance this morning 3 really interesting things of the time, and what they come down to is this idea of post-stimulus, where are we? Rubila Faruqi joins us now, Chief U.S. Economist, High Frequency Economics. Rubila, you've heard us talk here, and it all sounds like somebody's taking the punch bowl away. And it's maybe the fiscal punch bowl here, the fiscal punch bowl here. When President Trump says of President Biden, Bidenomics is not working, some would say that's stimulus. Are we needing to get ready for 18 months, 2 years of a lesser stimulus?
Good morning. Great to be with you. Yeah, absolutely. I mean, we saw extraordinary support from monetary and fiscal policy. And we are going to see the adjustment now on the other side. Monetary policy is already on its way, probably, in a very substantial way. And fiscal policy, we're not seeing the direct support, but we are seeing, that the effects of, let's say, Bidenomics or, all the initiatives that the Biden administration has undertaken, those effects are still filtering through. They probably will continue to filter through. If you're talking about the infrastructure plan or the CHIPS Act, those things will continue to filter through, probably through 2024 and maybe even beyond. So I do think this is an adjustment. I don't know, the U.S. economy has been resilient. It has proven, surprise to the upside over and over again. So yes, it's going to be an adjustment on both monetary and fiscal policy. I'm just not sure what the effects will be because, like I said, the U.S. economy has proven to be strong and has, weathered the storm pretty well.
Which is the reason why a lot of people are betting that maybe we're seeing the inflection point where inflation comes down and then it reaccelerates and heads back up toward the end of the year and into 2024. You're seeing inflation break-evens, the expected rate of inflation over the longer term, tick up meaningfully around the world. Are inflation expectations becoming unmoored?
Inflation expectations, the way we are seeing it, if you look at these measures, even if you're seeing the tick up in, break-evens, I don't see, evidence that this is an unmooring or unanchoring of inflation expectations. There is the risk. There's always the risk that, a resilient economy, a strong demand from consumers, and is going to be an upside risk for inflation. And, we saw that in the GDP numbers. And, that discussion is something that we've been having. It's just that the evidence that we're seeing on inflation, that just doesn't tally up with, these expectations. We think inflation is going to come down. It's going to come down meaningfully. Services spending is still strong, but it has decelerated. If you look at food services, if you look at recreation services, those are the things that the Fed is looking at. And let's not forget that housing component, that's going to be a pretty substantial, it's going to have a pretty substantial effect on inflation going forward. So our base case remains that inflation is going to continue to come down. It's just that, over the next few months, let's say in July and August, it's going to prove to be a little sticky. And, that's going to limit what the Fed can do, if they want to sit it out, right, or what they, need to see, later on in the year.
Just quickly, Robila, what's more important for you this week? To see the outcome of the Treasury auctions and what kind of supply and demand dynamic there really is right now, or the CPI report that we get Thursday?
CPI. For us, it's all about inflation and what those data show. Yes, Treasury supply is a very important component. We're seeing the effect on rates, but I think the inflation data is inflation and the labor market, right? That's what the Fed has said, that's what they're looking at, and that's what we're focusing on as well. As I said, we have said this previously, we are seeing an adjustment in the labor market. It is very gradual, and the same is true for inflation. We are seeing an adjustment. It's just that it's going to take some time to get back sustainably and convincingly towards that 2% target.
Patience, the buzzword of central bank speak at the moment, I'm sure. Rabita Faruqi of High Frequency Economics. Rabita, thank you. Looking ahead to the week ahead, Lisa's gone through it. CPI on Thursday, PPI on Friday. Lots of debt issuance as well across different maturities. So $42 billion of 3-year notes today. Tomorrow you get a 10-year offering. On Thursday, Tom, longer end of the curve, 30-year bonds, $23 billion worth come on Thursday. And most people concluding that's the test for this market.
In defense of Lisa, I think all of this is complete baloney. But the moment it doesn't work, there's no other story. There's no other story. If the auctions fail, and by fail I don't mean collapse, but if the auctions don't go as scheduled, every other story, including inflation, drifts away. Inflation to me is way more important until it changes. Will it change now? I don't see the jump condition in rates yet to see it. But
whether you care or not depends on how you diagnose the sell-off from last week.
Yeah.
If you believe it was down to the additional Treasury supply that was announced by Treasury last week, then these are key moments. They came out and had to announce additional issuance supply for this quarter, much, much higher than they previously thought it would be. And the first test, Lisa, will come on Thursday, down the longer end of the curve, and we'll see how it goes. And to Tom's point, if it doesn't go well, we've got a problem. And if it does go well, we'll move on pretty quickly.
And that does seem to be the theme. I will say, though, $38 billion of 10-year notes tomorrow, $23 billion of 30 notes Thursday. If they go poorly, how much do stocks sell off? That's going to be the interesting correlation. 3
standard deviations, 10-year yield, 4.27% is the mark.
Rob Waldner, 7:30 Eastern Time, from Invesco on fixed income. That's coming up shortly from New York. This is Bloomberg.
We're not full gloom, I would say, but yeah, we're not terribly optimistic that we will get this true soft landing. We're really less optimistic that this will end well, and that inflation will come back sustainably to 2% without some bigger downturn. If we are getting inflation sustainably back to 2%, that has to happen with some kind of, contraction, something that we would call a recession.
Veronica Clark there of Citi, some kind of contraction that we would call, a recession. Marko Kolanovic over at JP Morgan agreeing with her, talking about the soft landing delusion of the hopes and dreams of the equity market bulls. Those people, of course, have missed out on a rally so far year to date. UPS is negative in the pre-market. It's one to watch this morning. We're down by about 6.7%. They've cut their outlook for revenue. Plenty more earnings through the week, including the Walt Disney Company coming after the close tomorrow. Elsewhere in the equity market, equity futures at the moment negative by 0.5% on the S&P 500. Bit of risk aversion out there this morning. It's captured by the bond market. Yields are lower here by 9 basis points. Your 10-year, Tom, 3.99, just short of 4%.
Moments ago, Eli Lilly out with a little bit of joy to push against deflationary tone that's out there. They're looking at some revenue lifts as well. I guess the stock is getting some kind of lift here. We're just getting this out moments ago, but there's something pushing against it. I mean, it's up nicely. It's up 8%. I don't know where that's from. It's got to be a misprint, but. Nevertheless,
would you like me to go through the numbers?
I don't. The numbers are what they are.
We're not all mind readers. I'll go through the numbers. I mean, you mentioned the stock now. So here's revenue. This is what they see, Tom, for the outlook: 33.4 billion to 33.9. That's the range. They had seen 31.2 to 31.7. So that's a better range, Tom. For EPS, 970 to 990. They had seen 865 to 885. So they've raised guidance over at Lilly, Tom. The stock is higher by 8.5%, beating a race.
And maybe beyond COVID. I mean, maybe that's really what this is about, is American pharmaceuticals and all the rest getting beyond the pandemic. Not getting beyond the banking challenges of Europe, as our Patrick Barnard, he's in Frankfurt this morning here, on the Italian banks, but there was some knock-on effect. Why are the German banks going down as well? I mean, I get it. Unicredit and the rest down. Okay, challenges at the Italian banks. Why are the German banks affected?
Well, for two reasons. One of them is the German banks are highly skewed to higher interest rates because there's a lot of corporate and retail business in there. And I'm very surprised that the Italians have been the first one to introduce this idea, because we have a very capital market unfriendly government in Germany and a very anti-banking government in Germany since a couple of years now. And they have been pouched this idea a couple of times to put a tax or higher taxes on banks. And that's a very voter-friendly topic, so to speak, in Germany. So I guess if now Italy does the first step, they are very happy about this and be the next one to follow suit.
Are we going to see taxes in Zurich for the last bank standing? I mean, you can carry it right over to Switzerland?
That's a fantastic question. I mean, you have a big debate in Switzerland about all the taxpayer money that is going into the merger, even though it's just guarantees and it's not hard cash paid yet. But I guess again, there the voter would be very sympathetic to say okay, we helped you out, guys, for the screw up again after 15 years of the financial crisis. So now we want our money back. I'm not saying it's fair, but if you are a politician, this is a drum you can play very long and very loud, and you will get a lot of applause for it.
Jan Patrick, we've also seen all of the U.S. earnings of U.S. banks, and they highlight the market share gains that they have gotten from European banks, that finally we're seeing the light at the end of the tunnel of low-rate policies. But oh, wait. And then you're seeing some of these other policies come into the fore. How much do you hear about people opting not to work at some of these banks or opting not to bank with some of these banks because they are concerned about regulatory overhang that goes beyond what it is in the U.S.?
Well, I can't stop smiling when you say all that, because it falls into the whole category. Why this tax is now also being introduced is and why people are not buying banks and don't like really to work for banks is there is no shred of public sympathy ever at all for European banks. On the contrary, there's this feeling for 15 years now that they have a debt from all the help that they received during the financial crisis, where they screwed up big time, and that they have to repay this debt to the public if they ever can, if the public is ever satisfied with now you have paid off enough of your guilt that we helped you out so big and that you did not go bankrupt and that nobody went to jail for all the mess up that we have seen in 2008, 2009. And I have a feeling this will never change. And that's why it's so funny when people say the sector is cheap and it has good earnings and shareholder output. All true. Of course, it looks that cheap on paper, but there is no sympathy for the sector. So when you go in as an investor or as an employee, you have to be aware that whenever there's a chance from the public to take out money out of the sector, they will for sure do it. And they will not care about any shareholder return or stock market or whatever.
From a U.S. point of view, I saw the proposal this morning and I thought, really, is this going to go into effect, or is this just basically playing lip service to generate some popular support? You're making it sound like you believe it much more, that it will go into effect and that it might even serve as a template for other countries. Is that what you're saying?
Yeah, absolutely. I believe they will do it. I mean, like, the question is like not if they want to do it. The question is just like how big they want to do it. The banks can't fight it in the public because they will lose this argument for sure. Nobody will be on their side. So the only thing that they can do is like do their usual lobby thing, which they have also tried with like regulation and stuff. And they didn't prevent regulation in Europe. They only toned it down to a degree where they felt like, okay, this is doable, this is manageable for us, and we still can keep the shareholders sort of happy. And I'm pretty sure this will happen here again. They will work behind closed doors to make sure that this tax is not going to be out of the box and totally ruining any earnings report going forward from here. But I mean, like, now it's out in the open. And as an Italian politician, you can't like backpedal and say now like, oh, we're not doing it at all. The banks are fine, and we just like let them do their thing. It's not going to happen. Not in my boat.
We're making fun this morning, Jan Patrick. Out in Los Angeles, Disney is setting up a task force. I don't know if task force translates in Zurich or Frankfurt, but are they going to set up task forces at this bank? I mean,
yeah, for sure.
To me, it sounds like a perfect time to set up the Ferro task force of the Italian banks. John can fly over and consult for $10,000 an hour.
Yeah, absolutely. But yeah, there you say it, $10,000 an hour. So it's golden time for all the consultants, for the lobbyists. I mean, like, they will like in Zurich, they're popping champagne already. Not in Zurich, in Brussels, they're popping champagne already because like, yeah, this is going to be a 12-month battle for this tax to go, or 24-month battle, whatever, until this tax is ready, and they will like earn tons of money from it. And in the end, I don't know what they do, but like the banking sector in Europe, it's so screwed up. I mean, like I don't know what else to say.
He's almost like an American.
Absolutely exasperated. Cameron, this sector.
But I mean, like, what can you say? Like, the business model is very difficult. There's no sympathy in the public eye. There's no positive regulation. The interest rate story, I mean, it was nice, but it has peaked as well. They're always skewed when the economy goes down. I mean, in Europe, it's a different story in the US. I get that, but in Europe, it's horrible.
Oh, it's completely different here.
You should go for lunch with Lisa, Jan Patrick. That would be a hoot. Jan Patrick Barnett.
I'm having so much fun listening to you.
Just wonderful. Exasperated with what's been going on. Lisa, damned if rates are low and damned if they're high, apparently, over on the continent.
I love how Jan Patrick said, the interest rate story, it was nice, but now it's probably peaked. So here we are. I mean, the frustration here is even when they actually are able to earn income, then the public sentiment comes into fore. They haven't really washed out the sentiment deterioration that they felt during the peak of the financial crisis, and now they're facing off with a cost of living crisis. This is a different story, and it highlights some of the differentials between Europe right now and the U.S.
If Bill Gross was sitting here, he would point out, as John Taylor of Stanford has pointed out, and he basically invented the phrase, there was a great moderation. There was a entrenched trend of lower yields. Some would suggest lower volatility along the way. It's over. Pandemic, whatever, great financial crisis. But the great moderation, is it over? And what's it mean for all of banking, including, the stasis of European banks?
Well, clearly, anyone who was bullish the European banks has got a bit of a reality check this morning. Government officials have got other ideas. And to Jan Patrick's point, look, it remains to be seen what shape or size this actually goes through in Italy. Could be changed in Parliament, could be challenged in the courts. We haven't got a clue, but there's a feeling it just changes the mood music around the European banks.
Yeah,
Do the rate hikes matter?
Yeah, BNP Paribas, 6.8% yield, dividend yield.
Well, the French love a tax, don't they, Tom? You know.
Yeah. I mean, it's amazing. It is a foreign enterprise compared to what we see in the U.S. That was classic. It was really.
Thank you. You weren't interested in that story this morning.
I'm not interested in the Italian story. I've been listening to it for 30 years, but the knock-on effect of the other banks, I think, is a big deal.
You're interested now.
Deutsche Bank.
Okay. Binky Chada at Deutsche Bank is going to be joining us shortly. Equity futures on the S&P 500, negative here by 0.55%. Yields are lower by 9 basis points, a break of 4%, 399.99, and UPS struggling, cutting the outlook for revenue over at UPS. That stock is down in the pre-market. From New York City, this is Bloomberg.
Brought broadly speaking, the economy has been extraordinarily resilient to very high interest rates.
It just feels like this market needs to stop, pause, have a little moment of digestion, and catch its breath.
It seems like we're getting to the end of the Fed tightening cycle.
If we are getting inflation sustainably back to 2%, that has to happen with some kind of contractions.
There are signs that certain parts of the economy are reaccelerating.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market this Tuesday morning, negative by 0.55%. You know the runway, the calendar through the rest of this week. CPI data, the main event on Thursday. Looking abroad, the data out of China overnight, really disappointing once again, both on exports and imports. TK, weak imports, weak exports out of China.
And this evening we get to the CPI, PPI statistics for China as well, and they signal disinflation, if not outright price decline on a year-over-year basis for the CPI and PPI. It's a deflationary tendency across all of the Bloomberg Launchpad this morning. And John, I'm going to go to the 10-year real yield rapidly over 3 days, 1.80%. down to a disinflationary 1.59%.
The twin surprise of 2023 so far. China not as good as people thought it would be. The US not as bad as people thought it would be, Lisa.
And are those stories related? Not just because, there is an issue with the fact that their trade is declining, but the fact that Europe has been worse than expected recently. And that's the other side. And Europe is more tied economically to China than the US is at this point on a relative basis, simply because the U.S. has been reducing its dependence on China. So I wonder how much that might be the linchpin, the sort of long economic COVID of China, the linchpin to understanding some of the surprises this year.
Bank of America wrote about this recently, just the breakdown of so-called synchronized growth. There's nothing synchronized about this worldwide at the moment. China is slowing down more than people thought it would. The U.S. has been better than people thought it would be. We've got the potential of more hikes from the Federal Reserve when people were thinking maybe we'd get cuts later this year. Same with the ECB. And Tom, you go one step further. EM is cutting. Chile, Brazil, and others might follow as well. It's a really interesting setup. Divergence regionally just coming to the surface.
I think that's what Michael Spence would say, the Nobel laureate. There's no growth convergence going on right now. It is, as you correctly state, divergence. All these different narratives, Lisa mentioned this last week a number of times, these different narratives out there. And what do they add up to? They add up to central banks on an ex-post basis will have to react to it. How far behind Brazil are we?
True.
I mean, it's that simple.
Is it 6 months, 9 months?
They do okay there?
That was wonderful.
I was going to read it all morning.
A+, nice. Well done. Let me get to the price action. Equity futures on the S&P down by about 0.6% on the S&P 500. We're negative here. Yields are -2. We're down by about 8 basis points. Call it 9. Treasury's doing okay. Going into a ton of supply. Lisa's going to walk you through that. 3-year today, 10-year tomorrow, 30-year on Thursday, Lisa. In the FX market, a euro 109.52. Bit of dollar strength out there as well.
Fed speak today. We do get two Fed speakers. 8:15 a.m. we get Philadelphia Fed President Patrick Harker. At 8:30 we get Richmond Fed President Tom Barkin. I feel like they're being de-emphasized, to be honest. It's sort of like people shrug them off. They're going to try to guide one way or another, but there is no forward guidance. They're looking at the data. You need to come up with a long-term inflation projection. That said, we're still paying attention. 1 p.m., this is what I'm watching most closely. The U.S. is selling $42 billion of 3-year notes. This comes before tomorrow's $38 billion of 10-year notes that are going to be sold, auctioned off at 1 p.m. tomorrow. And then on Thursday, $23 billion, I believe, of 30-year notes will be sold. How many people step up to buy them at a time where the Treasury market has ballooned over the past 20 years? Just to give you a sense, it has tripled since 2009 to $25 trillion. So if you do have this increase in debt, who is going to buy it? If people do not step up as much, does that cause a complete risk-off feel? Earnings also today. Lyft, Rivian, AMC, Bumble, Duolingo, iRobot, looking for consolidation of power among the largest, seeing if there is any market share cannibalization from the likes of Lyft, which is underperformed, and Rivian, which is up a mere 32% versus Tesla's 100 gazillion percent.
Amazing. The doubling of Tesla, just absolutely remarkable. Some C-suite changes there too. We'll talk about that a little bit later. With us around the table here in New York, Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank. Morning, Binky.
Good morning, John.
I love a title in Southside Research, The Wobble. Can we talk about the wobble? What is the wobble in this equity market? What is that?
The wobble is that, we are basically overdue for a 3 to 5% pullback. It would be normal. And believe it or not, we are now running in, 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback. As I said, that's pretty normal. 3 to 5% pullbacks happen every 2 to 3 months. So it's getting a bit extended, number one. Number two, as you know, the rise in positioning this time around has been, pretty vertical, especially on the discretionary investor side. And so it's an additional reason, really, for looking for, when that process is over. So I'm not being normative about this as to what should happen. But, if and when that does happen, we'll tell you that part sort of played out.
What is the chata process to buy on the dip? I'm fascinated. You're sitting there like Ace Greenberg years ago at Bear Stearns. You got buy tickets over here, sell tickets over here. What's the chata process to buy in the dip?
To buy on the dip, I mean, you have to have a view on what's the catalyst for a correction.
You got to reframe your view 3 years out.
Not 3 years out, but, what's driving a pullback. So the kind of pullback I'm talking about is really more sort of a consolidation and, sort of you want to see positioning rise gradually rather than vertically as it sort of did starting in late May.
Does it make you nervous that everyone on Wall Street, all of your colleagues, are revising upward their expectations for the S&P?
It doesn't make me nervous. It's probably a little bit overdue, is the way I would put it.
You're like, welcome.
We are just reporting, basically, the second quarter of pretty solid sequential growth in earnings. So if this was GDP we were talking about and you were getting strong growth 2 quarters in a row, I think it would have an impact. The equity market tends to look at things on a year-on-year basis, so that makes the turning points very fuzzy to be able to tell. If you look at headline earnings growth year-on-year, yes, we are still running negative, but a lot of that just simply has to do with the oil prices from last year. You take energy earnings out and, it's first quarter of positive growth year on year after 4 negative quarters. I think it's more important to look at earnings growth on a sequential basis and also on an underlying basis. And really, if you look at underlying earnings, which is taking out energy, taking out the financials loan loss provisions, we've had 2 quarters now of 4% plus growth.
Yeah.
And we only fell 6.5% last year. So actually underlying earnings are at a new high. And, the narrative is about a recession.
Well, some people are also pointing to small business optimism, which came out this morning earlier, the highest levels in 8 months, right? So it's sort of edifying your view. How much do yields push against that? We were talking about what's more important for your equity call this week. Is it going to be CPI on Thursday, or is it going to be the Treasury auctions, and how many people step up to buy them?
Yeah, I think yields matter, but it's really been much more over the last 18 months. It's really been much more about the volatility of the message coming out of the rates market rather than the level of rates. So as long as we are talking about, 25 basis points here and there, this doesn't really impact my view. If we get a big acceleration in inflation and a big, response from the Fed and uncertainty increases, then, it's a bigger concern and a bigger pullback, I would say.
How many of these growth stocks are actually growth stocks anymore? I'm looking at their multiples, and they've got pretty tidy growth multiples on them, but how many are actually delivering growth?
I would say, the focus shifts over the course of the cycle. What we've basically seen is, the mega cap growth in tech stocks, their earnings turned around first and very strongly in the first quarter. And it was pretty V-shaped move if you're looking quarter by quarter. And that's now sort of widening out is the way I would put it. So, where's the growth? Trade. So first tech caught up with everyone else who hadn't fallen by as much. And the two have really, since late May, mega cap growth in tech and the rest of the S&P 500, they've moved really in tandem. But it does mean that since mega cap growth in tech earnings, since end of May is a very short period, but their earnings do grow faster. So actually, on a relative multiple basis, the relative valuation's coming in.
You might be annoyed with me for bringing up a single name, but I think everyone's fascinated by the move with Apple at the moment. Down for 5 straight days into today. Yes, they're trying to snap back this morning and bounce, but ultimately, are they producing the growth? Can we have the biggest weighting on the S&P 500, the biggest weighting on the NASDAQ 100, traded a multiple of something like 30 times forward earnings when it's not delivering any growth?
Yeah, so, I mean, as you know, I don't comment on individual
I'm just wondering from a valuation perspective, what the signal is that you take away from that name at the moment and the way it's performed.
Sure, but I think that's part of the process, of sort of the rally that we've seen so far broadening out. It's precisely that question that broadens the rally out because, if we are the market's running with the soft landing narrative, and if the soft landing is going to happen, then you're going to have cyclical growth, and so you should be rotating. And the market has, it's sort of sitting in the middle now. I mean, we're moving in tandem, as I said, after growth stocks just leading the charge. And at some point, I would expect, the next phase.
Okay, so you got a wobble. The Chata wobble is in place. Does that mean you reset your SPX outlook?
Oh, no.
Did we get to 5,000 this morning on pullback?
I think that, it's important to keep in mind that we haven't fulfilled even the 3% correct, pullback yet. So we were down basically
we're cratering.
I think, a return of normality after this big repricing that we've had, would be helpful.
Well, just for our listeners and viewers, John, I mean, can we get Chata to go to 5,000 today with the wobble?
Not today, but yes, it is our soft landing target. Yeah.
Binky, thank you for clarifying. Binky Chowner there.
Pleasure.
At Deutsche Bank. It's good to see you in a studio. 5K soft landing upside.
I thought that was incredibly
bullish
soothing.
thesis.
You got a guy with years and years of experience. It's just fabulous.
Mm-hmm. It's good to see you in person.
Thank you very much.
Welcome to the program. If you're just tuning in, your S&P 500 negative here by 0.6%. Coming up in the next hour, 8 a.m. Eastern Time, Mira Pandit at JP Morgan Asset Management. We'll continue this conversation. Big focus, Tom, on Apple and the way that stock has traded over the last week, down by about 9%, still up year-to-date by close to 40% year-to-date. We should state that. It's had a fantastic run so far in the year, but this is a make-it-or-break-it quarter, right?
It's make it or break it, but we've been here many times before. Someday it's not going to work. But I think what the fanboys would say of Apple is get out the calendar. It's early in August, back to school mystery, Christmas mystery, holiday season, boom quarter mystery, and every time this comes around with new products and somebody with a black turtleneck's got to walk out and give us the second coming of Jesus.
I'm not sure they wear the black turtleneck.
Well, whatever. But, the answer
we're
is,
on the same page.
Mark Gurman says September 22nd or something, you're going to be able to buy the new toys. John Farrell's going to go out and buy the iPhone 19 or whatever it is, and, life goes on.
I'll wait for the
That's
20.
the script.
When they stop manipulating the battery.
Yeah.
That's when I'll get
but the battery is much better. This battery,
is it good?
This is the single biggest surprise on this phone is the battery.
But Jonathan, I agree with you. Apple should not be trading at that multiple, and this is off, right?
It's off.
No, it's not.
Good to see you, Binky. Good. Deutsche Bank HR is right over there, Binky. Walk out in front of John's camera. See ya, Binky.
Binky, thank you. I actually don't think Binky realised we were still logging out. That's totally okay. Rob Waldner's going to join us shortly from Invesco. I'll try and remind him that the camera's still rolling. That was nice. Convinced he didn't have a clue. But it was perfect. It was perfect.
Completely.
Equities on the S&P, negative 0.7%. Are we too relaxed sometimes? People think we're not on air. Maybe.
Yes or no, did Donald Trump lose the 2020 election?
Whoever puts their hand on the Bible on January 20th every 4 years is the winner. Of course he lost.
Trump lost the 2020 election.
Okay. Joe Biden's the president. I don't think it was a good run election, but I also think Republicans didn't fight back.
That was the governor of Florida, Ron DeSantis, speaking with NBC. TK making his position pretty clear, I think, on the state of the 2020 election.
A lot of clarity there. Yeah, and I think the clarity is beginning to click in. And, the calendar's out, and it's completely foreign to the wonderful process of the British elections. But, it's August. Get out the date calendar. Well, how clear are they going to be in November? How clear are they going to be in late January of next year?
That's the playbook, though, isn't it? Just a little bit of a subtle nod at the same time by saying it wasn't a very well-run
Well, they got
election,
constituencies to play to.
Just a little nod there.
And what's interesting, and, this is a sidebar to what we're talking about right now, is I wonder what the language differential there would be from DeSantis, the governor of Florida, and Rubio, the senator from Florida. That's a real nuance there of constituencies.
And how this plays out in the debate stage, Tom. What are we, 2-3 weeks away from this?
Yeah, we're going to have full team coverage, and, we'll go there. There's a headline. You talk about, John, the headline flow. You mentioned UPS earlier. We'll get to the New York Times later. Dish Network will merge with EchoStar. Maybe like a mating under stress.
Yeah. Well, I'll try and get some more detail on that in a moment, Tom.
I just think it's a really interesting August here amid deflation and also the quiet of politics in Washington. Look at the Washington Post. Look at the New York Times. The news flow is next to nothing. A good time to talk to Wendy Benjaminson of Bloomberg News here on her sleepy Washington. I want to play off the governor of Florida there. It just won't go away. I mean, this question about January 6th and all, and I guess George is coming up here with an indictment and all. It doesn't go away. How long away is this debate? For these people that will debate the end of the month, is it tomorrow that they debate, or is there a huge news flow to get to the Republican debate?
Well, I think one of the news flows ahead of the debate in, an August where, the Congress is out of town and people tend to be on vacation. But the big news flow is who will qualify for the debate. And we just learned this morning that former Vice President Mike Pence did finally eke out the number of donors he needed. And ironically, that last rush of donations came since his former boss's last indictment for trying to convince him unsuccessfully to overturn the election. So it's all wrapped up in one big messy knot here.
Wendy, as simple as I can, and you've got such great perspective on this. Does America care?
I don't think voters do care. I think there's a small subset of Republican primary voters who are into this. There's also the small subset who are still moved by the quote-unquote anti-woke campaigns of candidates like DeSantis and Vivek Ramaswamy. But really, voters care about putting food on the table, about having a job with a decent wage, and that's what gets people to the polls in the morning. It's not about what's happening to some group of people they don't know or to an election that was now almost 4 years ago.
There's a narrative right now that regardless of what happens, Donald Trump keeps consolidating the Republican power behind him and the Republican voters and has the most likely chance of becoming the Republican candidate. Increasingly, you hear candidates pushing back against some of his claims, pushing back against him, including that Ron DeSantis clip we just played, where he said, yeah, Joe Biden is the president. No, it was not a bad election. How much does that hurt these candidates versus help them later on? Right? I mean, is there some sort of feel of what this does to the field?
Right. Well, I think, Lisa, you've actually set it out really nicely there, because there's the first hurdle of winning the Republican nomination. And then there's a much different hurdle of winning the general election, where you have to appeal not only to diehard Republican primary voters, but also to moderate Republicans, to independents, to that, mythical suburban vote, and hope to get some Democrats over to your side. And you're not going to do it in the general by saying that Biden was illegitimately elected. But first you have to get over that first hurdle. And I think you saw DeSantis in that clip trying hard to kind of find that hair splitting that he could do. Well, sure, whoever put their hand on the Bible is the president, okay. And then when pressed, he's like, yeah, Trump lost. I mean, we all know it, but it's become part of the GOP political rhetoric that maybe he didn't. And that's the thread they're trying to needle they're trying to thread right now.
I just want to switch gears just a slight bit, because this morning we've been focusing on UPS. UPS coming out and talking about how their expectation, the full year forecast, is lower than expected because of Teamsters negotiations, because of what the deal was that they struck with the union. Is there any sense of how much President Biden will lean into the union push, his, the most union-friendly president on record in this election cycle? How much is the White House talking about this?
Well, they are talking about it. They think they're talking about it enough. It looks like members of the UAW this morning don't think he's talking about it enough. The president of that union really wants the president of the country to weigh in more forcefully on labor issues. I mean, Biden has always made himself Union Joe, Scranton Joe, the middle class, work union member guy, and he is not getting that vote back. Also, the Democrats need that blue-collar working people to win the election. Sorry.
Well, it's really interesting to see. I mean, you go down from the fancy Hay Adams Hotel, and, AFL-CIO's got their throne there near the St. Regis Hotel. Wendy, as simple as I can, is union Republican or Democrat?
Union rank and file tends to be Republican right now. Union leadership is Democratic. And that's what both sides are trying to reconcile. It turns out, the union leadership were all for Biden last year, while the guys actually in the factories, men and women in the factories, were voting for Trump. And so it's they've also got to sort of get their own house in order before they can be a real political force.
Wendy, thank you. Wendy Benjaminson there, down in Washington, D.C. There's some tension, Tom. Union leadership and the people actually working in the factories. It's a big deal. It's a big deal.
Is it like this in England? I mean, is it the same thing in England where there's this new management partition?
It can be over certain issues, sure.
Yeah. This is a huge deal. And Sean, the head of the Teamsters out of local, I think it's 21 or 25 in Boston, really alluded to this. And that there's this huge divide still involved. And what the Teamsters did was get everybody on board. His revolution at Teamsters was to agree with the union, to agree with the rank and file. And that was the big change.
The year is 2036. I've been living here 20 years, and Lisa, it'll be the same question of is it like
100%.
This? I haven't lived there for so long.
Exactly.
But yes, it is to some degree, of course.
Yeah, of course. You're going to get that. And in Europe, when you were in UK, when you were part of the Teamsters, what are they called?
I was not part of the Teamsters.
You were the leader, remember?
Not a union
That's
guy.
That's what you were doing it last year. Remember? You were
but
like,
this is important. Our stereotype, John.
Not revealing my politics, but,
Our stereotype is the United Kingdom is much more union than America. Is that wrong?
I think the direction of travel is pretty clear in the States, Tom. From the 70s to now, it's declined a lot. And I think it's easy to say when you're in government at the moment that you're a union guy, when hardly anyone's in a union compared to 30, 40 years ago. Because would you be a union guy if we had the immediate pass-through from headline inflation into wages like we did in the 70s? Would that be a decent position to take on the economy, Lisa?
Would you be a union guy if UPS had shut down, if they hadn't struck an agreement, and then you had to come in with something that might have been punitive that led to that direct pass-through to rates that
Kill the
people
strike.
paid? Exactly.
Railroads.
This is a difficult moment. And you are seeing it in Europe, probably more pronounced than in the U.S. But you do have to wonder who they're going to go, what companies.
For me, the real test of a so-called union guy is whether you actually allow Labour to strike. That's the real test of it.
And you don't. No, you mean the president.
I'm saying to the president, that's going to be the real test of the president.
Yeah.
Have we seen
I think
that
that's true. No,
happen?
we
No,
have not.
It's easy to say, I'm a union guy. Let's see if you're going to let them strike. That's the real test.
I would agree with that.
Equities right now negative on the S&P from New York. This is Bloomberg. Equities negative here on the S&P 500. We're down by 0.7%, pulling back after snapping a 4-day losing streak on the S&P 500 in yesterday's session. The Nasdaq down by 0.8%. A lot of attention on Apple. Longest losing streak of the year so far. 5-day losing streak. Could be 6. We're down slightly this morning at the pre-market by 0.2%. I'll talk about UBS in just a moment. UPS is down by about 4.9%. Underperformance on the Russell, the small caps. Equity futures down across the board here. In the bond market, 2-year, 10-year, 30-year. Bit of risk aversion out there, I have to say, without an obvious catalyst, without the exception of maybe what's going on with Moody's and banks, but not a lot stands out here, apart from perhaps throwing some China trade data. I don't know. We're down 10 basis points on a 10-year, 398.59. On a 2-year, Lisa, negative 4 basis points to about 472. Pick your poison. What is it this morning?
I am very curious, and I'm curious to hear this from our next guest, whether the real institutions have finally started to come in, given the fact that yields got to that 4% level. There was sort of this tentativeness. What are we missing? And it seems like people are saying, they're just getting over their skis with the inflation calls. Let's buy. Let's lock in 4% yields.
A bonds rallying going into this. Under surveillance this morning, a deluge of Treasury auctions set to test investor appetite.
So made you do
$103 billion of 3-year, 10-year, 30-year auctions being held this week. The biggest round of refunding since last year, Tom. The 30-year
Okay, who's going to
Thursday,
show up?
10's Wednesday, 3's today.
Who shows us? Does Japan show up? Is that the tension, Lisa? You're expert on this.
Well, I mean, I think that some people speculate there will be fewer Japanese buyers, but that's a long kind of process. That's not going to be now because yield curve control has been abandoned. That kind of, drama isn't going to be there. There is a question about whether the bond vigilantes are going to feel emboldened based on the Fitch downgrade of the U.S., based on how much there was a surprise upside in the amount of debt that the Treasury was selling.
In an auction deluge, is there a difference between 10-year demand and 7-year? I mean, who owns 7-year paper? 7 years, like only Invesco buys.
Well, that's going to be the real test of this docket of supply, Tom.
Yeah.
The additional supply that we got from Treasury that was announced last week, the real test is going to be out on the long end. Because the sell-off we've seen so far has been on 10s, on 30s. If you look at the yield curve and the inversion, deep inversion, 2 weeks ago, negative 100, right now about negative 70. All of that re-steepening, if you want to call it that, Lisa, has come from the long end of the curve. And it's not just the downgrade. It's not just the supply. It's the BOJ. Pick your poison. There's a lot out there that's come together that's pushed this Treasury market in the wrong direction.
Real yields are rising substantially. You're also seeing inflation expectations of the longer-term rise. Is this time different? Where suddenly we do get a reacceleration of inflation in a new era of monetary policy restraint, really, and actually having rates higher than they had been over the past couple of decades.
I mentioned a downgrade, not Fitch, but Moody's this morning, downgrading 10 small and mid-sized US banks, citing a dimmer outlook. The rating agency writing this: rising funding costs, declining income metrics will erode profitability. The first buffer against losses. Assets risk is rising, particularly for small and mid-sized banks with large, guess what, Tom, commercial real estate exposure.
I would look at CRE, people downplay it. They say, well, it's just office buildings, work from home and all that. I'm like, maybe. What I'd also look at here, John, is the tape. Equities, bonds, currencies, commodities picks up on this single news story, and it advances here in the last 60 minutes. Just to give you one idea, John, 10-year yield to 4 digits. It's a 3.98 handle.
So if you had to pick the poison this morning, Tom, you'd pick out this story for this
no,
move
China.
this morning.
China overwhelms it all, but it's a summation of stories here. It's, there's nothing going on. It's August. Barbie's over. We got to have things to worry about.
Barbie's still selling out, I think.
It is. It's like gazillions.
It's nuts.
Sweeney says it'll pop $2 billion.
$2 billion, really? You've seen it?
I've been 5 times.
What's the review?
The kids loved it.
They liked it?
Yeah. I mean, it was
Come on, Lisa,
bubblegum.
Beach
What are you
Ken.
holding back for?
Come on. Had a good message.
PC Bramo.
Okay,
wearing
no,
pink today
well,
on
the
radio.
truth-
Think.
Okay,
Come on.
the truth is, it's a really thin story that's really irritating on certain levels and somewhat heavy-handed, but it has this sort of like nice overlay of sort of messaging. To me, it was like a 2-hour build-up to the last line, which that was the punchline.
What was the punchline?
That Barbie was going to see a gynecologist.
That's the punchline.
Can we say that on radio?
Are you serious? That's the punchline.
Yes. Let's move on.
I don't get it. What's it? What does that mean?
You've never
It's
had
a little
Barbie,
dry
have
British
you?
humor there.
No, I
Lost in
don't think
translation.
it is. I don't think it is.
What's the significance?
Well,
Why
that
is
she's
that a
actually
punchline?
become a woman, and when the plastic doll is, anatomyless. So
The what?
it's sort of the concept of her becoming what it is to be an actual woman rather than the image that was sort of foisted upon
Right.
the girls that were playing with the dolls.
Tomorrow, folks, the Bramo review of Oppenheimer.
Let's not do this again.
You just defined what a woman is. It's shaky ground these days. You know that, don't you? UPS shares slumping. The company lowering its full-year profit forecast as it deals with changing consumer habits and rising costs. After a tentative labour agreement, the stock is down by 5%. The company now expecting revenue to be $93 billion down from its prior forecast, Tom, of 97. That's a cut to the outlook this morning.
It is. It's important to me. It is logistics. It's like FedEx. It's a real thermometer of what's out there. But I'm going to go to the labor cost headline that we saw of Teamsters is a real adjustment of selected companies to come, including all the tension we see in UAW. What's this do to Ford and GM?
Yeah, and others too, Tom. And then we've got the story tomorrow, isn't it, after the close, the Walt Disney Company?
Yeah. Task Force
from
Task
Reuters.
Force, don't get me going.
Focused on AI.
Look at New York Times today out with bang up earnings, no tax.
AI in the media, that is a big deal.
Oh,
That's
yeah, it's a theme.
Big deal.
You go to lunch, you go, AI.
Have you seen those videos where they can do like a mafia version of Harry Potter?
Mm-hmm.
You can just
No, I've not seen
it. I actually didn't. That didn't come on my timeline.
You should check that out. It's fantastic. They can do really, really cool things with this stuff now. Do you need the actors, the actresses? And that's where the tension is right now between the striking Hollywood stuff and the Bob Igers of this world who would like to, I imagine, I'm not speaking for him, but you'd imagine if you were running a media company, you'd like to just clear the decks of some of the costs. And Tom, there's a strategy there to be had.
You want me to Segui here?
Please.
I'm Segui here. Just S&P futures negative 35. To be clear, the tape deteriorates. This is an important interview, without question, our interview of the day in fixed income and all that it means across equities, commodities, and foreign exchange. Rob Waldner is out of the vintage of Newtonian calculus. That would be engineering at top East Coast schools with a heritage back 200 years. He's Princeton civil engineering, and that is a rigor about statics and dynamics that he brings to fixed income right now. This is not statics in the fixed income market. What is the dynamic of all the algebra, the math of fixed income right now? What's the dynamic that you're focused on?
Well, Tom, you were talking about it earlier in this in the show, which is the news around disinflation and almost sort of seems like deflationary sort of vibes that we have out there. So we're getting U.S. CPI data on Thursday. We get Chinese data tonight. Chinese data CPI is likely to come in negative year on year. U.S., I think the Bloomberg consensus is we'll get a 0.2 on core and 0.2 on headline month on month. So the data is starting to come in as we've been anticipating, very disinflationary. And it looks like, certain areas like China and the trade data we got overnight feels more like deflationary. And I think that's what's going on in the bond market here is people are finally realizing or looking at that and thinking, hey, if I can get a 5.5% for an investment grade bond portfolio, and we are in a disinflationary environment where where growth is going to be, mediocre, that sounds pretty good, right? So that's where the buyers come from.
So there's a tug of war right now between disinflationary forces and additional Treasury supply. You don't think that Treasury supply wins out? You don't think it's as important as the disinflationary forces when it comes to what this bond market's going to do?
Day to day, the Treasury supply can drive things, and I think you were talking about it earlier. That's probably part of what's revalued things last week, is looking forward to that supply. But we know that in any medium-term, month-type horizon, supply is not the driver. It's the macro forces that drive real yields.
So have you been buying this bond sell-off?
We are positive on duration. We've been looking at this Treasury, if you want to talk about the Treasury for a second. We think the 10-year has been in this 3.5% to 4% range. I'm actually getting a little more positive than that. So thinking about that here is a great buying opportunity because, one, as I said, you have a disinflationary environment with relatively moderate real growth. And so that in the medium term, that's quite good. And then if I start to think about the risk scenarios are that the Fed overstays its welcome here. We have several Fed members saying they think they need to hike again, even though we believe we're in a disinflationary environment. That could be quite negative for the growth outlook. That could create, a dislocation, and that would be very positive for the Treasury market.
So, in other words, when we're talking about these auctions this week, are you basically saying, yes, let's go? I can't wait to load up on both 10-year and 30-year Treasuries.
I think that, this is a great time to buy fixed income. And if you want to buy Treasuries, if that's your asset of choice.
So who is coming in and joining you? Are you seeing more institutions who are doing the same thing that you are? Or is it still the international buyers, still the same buyer base, and that we're all just making a lot of noise over nothing?
Well, you have the same buyer base. The same international buyer base is still there. Fixed income flows have not turned incredibly positive yet, but we think that's likely to come.
Can we talk about the new floor in global fixed income? Now the BOJ is pulling back, the ECB has pulled back. The Federal Reserve has taken rates to 5.5%, and people think maybe they only come back to maybe 4, 3.5, something in between. What is the new floor for global fixed income? If you get into trouble, what do you rally down to, just in terms of yields? What are the limits of that rally? Because people don't think it's zero anymore. What is it?
Well, we'll have to see where that pans out, and it depends on what a recession looks like, how far we get down.
Have you developed thoughts on that?
But we think that it's something in the range of sort of a more normalized yield curve would see, a more steep yield curve, and if short rates get down to 1, you're talking about 10 years at 2, 2.25.
You think short rates will potentially come back down to 1
in a recessionary type environment? Yeah.
Interesting, because Lisa, the kind of pushback I've heard is that perhaps you come down to 3.5, 4, something like that. I think that was Mike Gapin's point over at Bank of America.
That essentially inflation would be stickier for longer, and that would keep the Fed at a higher level, that they weren't going to go back to the low rate kind of environment. And I just wonder how much this is really the poles of the debate right now, people who believe we're going back to the environment we were in before, and those who say this time really is different.
What are we going back to?
I would really point, we live in a nominal world. I think sometimes we get confused by this real and break-even stuff. We live in a nominal world. Nominal growth is coming down very, very quickly. So inflation's coming down, and growth is coming down. So, if you think going forward we're nominal growth somewhere in the 4.5 type of range, that's a tremendous environment for fixed income, right? And if nominal growth settles at something below that, then you could see rates come back down.
Rob, this was great. Thank you, sir. Rob Mulder there, Invesco. Good to see you in person.
It's
been
great
too
to be
long,
here.
hasn't it? It's unusual. I think it's been a few years, right?
Since I've been on this set, I think,
Crazy.
or this new set.
Rob, thank you.
It's not new
Which
anymore.
is not so new anymore.
Yeah, exactly.
I've had this a few times, right? We've had this a few times over the last 6 months where we just haven't seen people in person for that long. If you are just tuning in, welcome to the programme. Equities right now negative by 0.75% on the S&P 500. Coming up at about 8:30 a.m. Eastern Time, Stephen Stanley, Chief U.S. Economist at Santander U.S. Capital Markets and one of the most accurate forecasts of the labour market on the street, Tom. That conversation just around the corner.
I can't tell you how timely this call is to see what we get as an adjustment from Mr. Stanley. And I'm going to go again to this price overlay. And, as Michael Darder would suggest off of what Rob Waldner just said, is you get real GDP to flatten or even come in a little bit, fine, no big deal. But if the inflation component comes in, all of a sudden you have nominal GDP under 5%. I can't fathom it could get under 4%. And that's where you get back to what Ed Hyman, among others, has been talking about, which is a real disinflationary tendency.
And other people say that
and the Fed reacts.
Because the economy has been so resilient, because of the fiscal stimulus, because of the unwillingness to really cut the budget, because of the debt overhang, suddenly you end up in that higher inflation, higher rate kind of reality. These are the poles of the market right now. We don't know where we're going. And this is the reason why actually I care less about what the Fed is saying in the immediate term and more about longer term, any kind of benchmarks to understand where we're heading.
Chairman Powell, later this month, potentially at Jackson Hole.
All right, I am interested in that. I mean,
it's one to watch.
You think he's going to show up?
John, seriously, 7-minute speech.
No, I've not said I don't think he shows up.
No. You were saying you wonder if he shows up.
No, I wonder if this is the right time to make some kind of definitive defining comment on the disinflationary forces we've seen so far.
That's
when you just
point.
have the luxury of waiting for one more print after this one before September 20th.
That's a good point.
That's my question.
He could come out and just say, "Look, I don't know.
Yeah,
you don't know.
He has the luxury. He has the luxury of waiting.
Yeah.
And I think
independent.
Nobody's sort of like dying to hear from him later this month.
Exactly. So he can really underwhelm.
I think it's actually a weaker dollar forward. I think the FX market is in kind of a tough spot at the moment in the sense that it's difficult to really navigate a lot of these cross currents. The Fed has the ability to start pivoting towards the end of the year. That's the dominant driver for the FX market.
Everyone talking about Barbie in my ear, distracting me. I haven't seen it.
I haven't seen it.
Just give me a chance, then you get my review.
You're going to see it?
I'll watch it eventually, yeah. It's not the kind of movie I feel like I need to go to the movie theatre to watch. I watch that at home.
In the privacy of your own home where no one can see you watching Barbie.
And then I might have things to say, after I've seen it. I'm open-minded about what the movie's going to be like.
I think you should be. I'm looking forward to your review.
Good. Vasily Serebrikov there. of UBS on other things, not movies at the moment. Equities right now, down 0.75%. Bit of a sell-off this morning. Stocks are lower. Data out of China, not great. Downgrades of US banks by Moody's, 10 and small and medium-sized lenders in America. Talk of a banking levy over in Italy. So the mood's just soured, I would say. There's a rally in the Treasury market. Tom, yields are down 9 basis points, and the dollar's stronger. Euro-dollar 109.44.
It's a reversal. Rob Waldner of Invesco just moments ago talking about the overlay here of disinflation, deflation. I mean, these are tangible things. Let's be clear on this. Inflation for real. Disinflation's just less inflation. Deflation's actual price declines. See Europe in the 30s. Reflation's a cosmic thing. It's not really an economic concept. Nobody's talking about reflating, even though we've stimulus our way maybe to one big reflate over the last 5 years.
We're certainly talking about weaker growth out of China at the moment. Yeah. That's for sure. That's for sure.
We're going to do that right now, and we're going to get a terrific brief linking in the markets into the economics of the moment. Damian Sassower joins us, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. He has agreed to appear this morning on Bloomberg Surveillance if we don't bring up the dreaded New York Yankees. China, the COVID. They came out of COVID. Things are going to be great, and then not. What's from 60,000 feet? What's the why of the immediate slowdown we see in China?
Well, Tom, thank you for telling me what disinflation is. I really didn't know that. And deflation.
A lot of people confuse them.
I get confused. I get confused. I get confused. No, seriously, the data overnight. I forget about exports and imports. The data overnight out of China. I'm talking foreign direct investment, which a lot of people aren't talking about. Down 87% to its lowest level since 1998. Remember what China's exports are. 30% of all Chinese companies that export abroad are foreign companies operating in China, right? So that 30% of that number. So when you see, exports are down 14.5%, we knew it was going to be bad. It's the supply chain diversification theme that is really kind of resonating with me. The fact that it's, foreign auto deal like Mazda and Mitsubishi are basically scaling back operations in China, like Stellantis, et cetera. And so, for me, it's just more of the same. I mean, obviously imports are down. We know the weakness domestically. We know the property sector bubble. Did you hear that Country Gardens defaulting on, coupon payments this morning? Go figure. So a lot of that hasn't changed, but again, it's how is it spilling over into the broader economy? And this is where it gets interesting, because if you look at the major emerging market currencies, all 22 of them, over the last 1 day, 1 week, 1 month, and 3 months, not one of them is up. And this has a lot to do with the yuan. It's
like the economy that cried wolf. We've seen signs over and over again in certain periods of an economy that's going into something difficult, something bad. And it looks like all the ingredients for a balance sheet recession, but no one really wants to engage in that conversation because they feel like they've had it multiple times over the last decade and they've been wrong. Does it look like this is going to be a balance sheet recession in a place like China, given what you're seeing play out right now?
I guess we call sub 5% GDP growth year over year a recession in China, right? Because that's really what happened. I mean, let's think about where we were in the beginning of the year before the reopening. It was going to be, 4% growth in China, which is dreaded. It's awful. It was going to be terrible. Then everybody scaled it up to 6% on the reopening, and now we're back down to people talking about maybe it's going to be a 4% GDP growth handle for full year 2023 in China. It really doesn't matter what the number is because they are not stimulating the economy. They just can't get sentiment right. This is cyclical, And so for me, it's, if people don't want to consume in China, if people don't want to buy, you're just going to see, we all talk about the inventory stock up during the COVID window that all these industrial companies in China kind of did, and now they're kind of working their way through that, and that's what's leaning on inflation, leaning on deflation, pushing that kind of narrative through. But it's just really, really tough on the ground. And our friends at China Beige Book, they do a great job on this, and they have some alternative indicators that we look at. Things are not good in China domestically.
Forget the GDP number, you're right. What I really want to get at is whether we're seeing the essence of a balance sheet recession, where you can't really stimulate your way out of it because you're just going through this period of deleveraging. Is that what the consumer is beginning to go through, this period of deleveraging? It doesn't matter how attractive you make that second, third, fourth, fifth property to me. I just don't want to buy it.
Of Japan. Yeah, the Japan dilemma, basically. And I can't really comment on that because it's just really hard. There were so many different structural and mechanical factors in Japan that makes that case so different than what we're seeing in China. China can grow its way out of this. They really need to stimulate again. And what's that going to do to their fiscal state? Remember, China's fiscal deficit to GDP is actually coming down despite all the rhetoric and the talk about how they're going to stimulate the economy. So, what's next?
And then there's a question of the read-through to the rest of the world, both with the developing world, which I know you track very closely, as well as in the developed world. I think about the U.S. This from the Census Bureau. U.S. imports from China were down 24% during the first 5 months of 2023 versus the same period last year. Chinese products accounted for roughly 1 out of every $6 Americans spent on imports, down from nearly 1 out of every 4 pre-pandemic. How much is this a U.S. disaggregation from China, and how much is this a global, we're not going to rely on you in the same kind of way?
Such an important point, because you're right, 23.1% decline in the U.S. It's double digits across the board. I'm talking the EU, Japan, Brazil, Australia. All of them are double-digit declines year over year in exports out of China this month. So, look, I mean, it's more of a global. It's more global is really what I'm trying to say here. It's not just the U.S. The supply chain diversification theme is real. It has to do with Beijing's interaction with foreign companies. Look, you really think Beijing cares about the profitability of its local Chinese companies, Tom? I mean, they haven't shown any willingness to want to bail anyone out yet. Yeah. I mean, so, I think it's suspect.
I got 8 questions going to China, but something's more important. Bloomberg Business and Sports, you work with Michael Barr and Scarlett Fu. John Ferro was absolutely flabbergasted that a sports announcer for an American sports team could be fired by their team. And I tried to explain to him the heritage here, going back to Dizzy Dean, Vince Scully, and the rest of it as well. The Baltimore Orioles had an announcer who said, not negative things, but just stated some facts about their wonderful season. And it's all blown up for the greatest story in baseball this year, hasn't it?
Well,
Tell me about free speech and announcers in sports.
Well, look, I mean, the Major League Baseball is doing a lot of things right. I don't want to talk about what they're doing wrong. I mean, they've changed a lot of the rules. We've had Randy Levine from the New York Yankees on. Everybody's pretty happy. I mean, have you been to a baseball game yet this year? They're 2 hours. They're amazing. Right. It's a wonderful experience.
Why would the Orioles do this?
But why would the Orioles get rid of their announcer? I don't know. I'm not a Baltimore fan. I mean, they're having a pretty good season, I mean, I love Camden Yards or the new stadium. Where are they playing
Does
now?
Michael Kay get told what to do with the New York Yankees?
I think Michael Kay is far smarter than he doesn't need to get told what to do for the New York Yankees.
John, is there an English analog here?
He's kind of like you all. He knows exactly how to answer these questions. He knows where he gets paid from.
So Kevin Brown basically just highlighted how poor the Orioles were against Tampa, their record.
Yeah.
And then gets suspended for that.
Can't be the only reason.
It doesn't make sense to me. Are they propagandists or are they meant to be commentators? I mean, they're just highlighting the facts.
Marino, I don't know what the Orioles. I have no idea. I mean, but look, if you want to, I mean, it sounds bizarre. I have to read up on it. But look, what I will say is we had the pleasure of AC Milan's chief revenue officer was on Bloomberg Business and Sports last week. We asked him a few questions about what's going on.
He wasn't invited.
Well, we wanted John, but he was too busy. John was.
They spent a lot of money this summer.
He's in a lot of properties he's managing right now for Bloomberg. So.
Trying to.
Yes.
Very difficult.
An invite would have been nice, but spent a lot of money.
We had Jerry Rice on. We had Jerry Rice on yesterday, and his daughter, Lovely. They're marketing some new goat fuel, a new energy drink, really fascinating.
Wait, goat fuel?
Goat fuel, because he's the goat. He's the greatest of all time. Jerry Rice, wide receiver, San Francisco 49ers.
Very good.
I was picturing an energy drink.
One big shameless plug.
There's a goat on the drink. There's definitely a goat on the can.
Goat fuel.
If Joe Castiglione mentioned that the Red Sox had done poorly against the New York Yankees, they would have been like, that's life.
Is there goat fuel in London?
John Ferro, the foreigner's 100% correct. It's a complete, total outrage that they went after that guy for something that, if he showed up drunk, that's different.
The Orioles have a history of making a mess of things, don't they?
Who is the analog
of the
Orioles in the UK?
Yeah.
I'm introducing you as the foreigner when we go to London in a few
weeks.
Do that. And
I feel like I'm a foreigner when I'm there.
Damien Sassa, you love it.
Do you know that every cigar bar I go in, everyone's for Arsenal? That's what I've learned.
Which cigar bars are you going to?
There's a little cheap one over there. It's on the west side. It's a little
in Mayfair.
Yeah, it's
a
like
little cheap one.
The Langsforth or Longsforth.
Cigar bar. What do you expect?
Okay. You back on the cigars?
Yeah, we like cigars.
Okay.
We have a celebratory cigar.
What, once a week or?
Once a month. Once every 6 weeks.
I don't believe that. I can always tell. I get the call from TK in the afternoon, and you can just tell when you're.
Yeah, well, I got the dog. I got
just
the vet
hear it
bill.
In the breathing pattern.
I got the vet bill and kettle fee, and we're
voice.
hanging. Yeah,
Okay.
Yeah.
Okay. Mira Pandit at JP Morgan Asset Management joining us shortly. Damien, thank you. Thought you were coming on to talk about China and emerging markets. Get real. From New York, this is Bloomberg.
We are in recovery mode, and the shape of that recovery doesn't look so fantastic.
This equity market never priced in a recession into earnings.
It's difficult to really navigate a lot of these cross currents.
We're not terribly optimistic that we will get this true soft landing.
We've been in the soft landing camp, and I still hold to that view. And I think when you think about soft, there's going to be bumps.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is a busy Tuesday on radio and television worldwide. Across this nation, deflation is in the air. John, it's a summary of what we've heard from everyone. I thought Rob Waldner at Invesco was just brilliant on this. It is the overlay in his fixed income calculus.
It's a blend of stories, Tom. Data out of China this morning, not great. Imports, exports, terrible. That's been a theme so far of the year for China. Downside surprises. Throw in some downgrades for some US banks, Tom. 10 of them, small and medium size from Moody's, and maybe even more to come. Throw in some debt supply, Tom. 3-year today, 10-year tomorrow, 30-year on Thursday. The toxic brew, as Brammer might call it.
Yeah.
Equities are down this morning by 0.7%, 1%, TK. Pick your poison.
The toxic brew here is that tension that's out there, and yet Bikram Chadha of Deutsche Bank came in here and said, pull back. And that's the other side of it, like Eli Lilly's earnings today. A lot of negative earnings like tone, and yet Eli Lilly comes out with a better than good earnings report, and that's what Binky Chadha is talking about.
Called it a wobble. Called it a wobble. A wobble.
Sounds better with a British accent.
UBS having a wobble.
Wobble.
The stock is down by 5% at the moment. How long do I need to live here before you just treat me like a local? You know, like a New Yorker. Like one of your own.
Lisa, come on, you can answer that. I don't feel like a local here.
He's asking you specifically. I don't think he's asking in this generic way.
But you're the New Yorker.
Yeah, but I think the thing about New York, the New York spirit is that people who come here and consider themselves New Yorkers are New Yorkers.
Thank you.
That is the spirit of New York City.
New Yorker. Thank you very much.
Good morning, Mayor Adams. We welcome all of you across the nation. Please visit New York soonest to talk to New Yorker Jonathan Ferro. Lisa, we have auctions. I don't care. Explain why I should care about auctions in the coming days.
You started the show saying that it's deflation Tuesday or disinflation, and that's the vibe. That is really the key question, is it? And a lot of people aren't buying it, and that is the reason why these auctions are so important. If you have the world's biggest economy with a debt overhang like the one that we have at a time where unemployment rates are 3.5%, doesn't that lead to inflation? Doesn't that lead to at least higher rates and people not wanting to buy the debt that has to be sold in greater quantity? If you do have any kind of buyer strike, how much does that lead a real risk-off feel across the market? Rob Waldner not buying it. He's loading the boat. How many people are going to join him?
One idea to get to the data, John, and this is the foreign exchange market. I'm sorry, we creep stronger dollar. I'm watching Euro Swissy, John, to see if we get strong Swiss franc, sort of the global disinflation, deflation angst, a little bit of that, but I'm not there yet.
There's some risk aversion out there, Tom. Stock's down by 0.8%, actually near session lows, an hour and 27 minutes out from the opening bell. The bond market rallying, yields are lower by 9 or 10 basis points. The 10-year 3.98.99. Tom, you went to the FX market, dollar stronger by 0.5% against the euro, 109.43, and crude pulling back to about $80.11. We're negative here by a little more than 2%.
Good morning, everyone. With futures again deteriorating, negative 35 down to negative 36 as well. We're going to get a brief on these markets right now, and I love what she says about August and summer. Mira Pandit with us, global market strategist, J.P. Morgan Asset Management. You said, Tom, you're jogging in place. You sound like the entire Keene family, because that's what I do. I jog in place. What does jogging in place mean for a market that's been a moonshot since October?
When we think about the market and the risks here going forward, there's not a whole lot of upside risk here, but I think that the downside risk is somewhat limited. Because if we think about where we are with the markets, we are in between the inflation spikes and the Fed hikes, but also waiting for the economy and profits to sour. So I don't know that there is a whole lot of upside catalyst in a world where profits are just better than feared. We need to see some more out of the profits landscape in order to get some more upside from stocks that have already rallied really hard and that have already experienced some pretty high valuations. But at the same time, until we see some more souring in profits in the economy, I think we're in an environment where stocks are essentially jogging in place where we are today. Right. And that's not just for stocks. I think it's similar for yields. The pop in yields we've seen more recently, I would attribute that mostly to the pop in growth. Yes, there was a Fitch downgrade. Yes, we're seeing some inflation break-evens move a bit higher. But really, it's all about growth if we think about this higher yield environment since the May FOMC meeting. So if we consider that environment, I think that yields, too, for the rest of the year could kind of jog in place until next year.
Your charm at J.P. Morgan, this is English major out of Tufts CFA, which I think is the coolest thing going. I can't imagine what the CFA was like for you coming out of that wonderful background. You write the documents at J.P. Morgan. You actually craft the documents that you're putting out. What are you writing right now about 60/40?
Right now, if we think about the 60/40, it's had a huge rebound over the course of this year. Last year, the 60/40 was dead, but I think what's important to think about with diversification is that markets and the economy look in opposite directions. Markets are very much forward-looking. The economy is at best looking at where we are today, but also looking backward at the data we've already seen. And if we look at periods in history where the 60/40 has struggled, take 2008, take 1974. If you look at the next year, 1975, if we look at 2009, those were by no means good economic years, but you did see the markets rebound. I mean, 2009 is a great example where you see markets bottom in March. We start to get out of recession in the summer, and actually the unemployment rate continues to rise until October. I think that's a helpful guidepost for where we are today, in that the market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize, but the market is already sort of looking a little bit beyond there. And that's a good environment for diversification.
What do you say to a client who theoretically comes up to you and says, hold on, this time is different. Inflation's going to accelerate. These bonds are going to be worthless. It's going to wreck our valuation of the stocks, of the stock holdings that you currently have. We're focused on something that's really problematic. We want to just hide in cash. I don't see how you could be calling for yields to go back down to something that was normal. What do you say to them?
Ultimately, if we look at cash right now, clients love a guarantee. If you can get a guaranteed 5% in a CD, that seems great. But the reality is, if you think about something like a 6-month CD, you have some reinvestment risk there when we think about the arc of the year. And with yields where they are now, with above trend growth, well above trend growth, really for 4 quarters in a row, if we even start to see slightly sub-trend growth, you're going to start to see yields come down. If we see inflation soften a little bit more, you're going to see yields come down. Doesn't mean they need to crater this year, and again, they could be jogging in place a bit, but as we head into next year and we look at that 12-month outlook, yields can start to come down. So when you sit in cash, you have this opportunity cost where your income can potentially come down, but also you don't get the benefit of the upside. Within stepping out a little bit in the risk spectrum to bonds, you can potentially lock in income for a longer period of time, and in addition, have that potential for capital appreciation.
We've been talking about the auctions this week and how the U.S. Treasury Department is selling a greater amount of debt. Are you saying this is a good time to buy? That 4% on a 10-year yield, to lock that in, seems like a really nice opportunity.
The window for the bond market has been extended over the course of the summer. It is, of course, a setback in terms of that recovery that we were hoping to see throughout this year, but it does extend that window of opportunity from an entry point standpoint. One of the biggest challenges that investors are dealing with today is price. Where do you find something at a reasonable valuation? Now, I will fully concede that if we look at debt and deficits over the next decade plus, with deficits coming in at 5.5% to 7% on average, that is historically high. And we are going to deal with a yield problem over time. But I think given the economic backdrop in the near term, this is a pretty good entry point.
What does it sell right now to high net worth people about cash at a 5% yield? Are they comfortable with that, or they're saying, wait a minute, why can't we buy more Apple?
You see that clients are comfortable with it because, again, you haven't had that type of yield in so long. But I think getting back to your question about the 60/40 and how we broaden out that allocation, we're also seeing that people realize this is not a market for easy money. It's not just that you're going to experience beta that's going to go up. So people have to be a little bit more discerning in how they're investing, not only around the world, but in terms of types of vehicles, thinking about alternatives to enhance different outcomes for income, diversification, capital appreciation. So I think that people are really sharpening their pencils.
So you're saying this time active management wins. Into 2024, active management will beat index.
Take a look at profits, take a look at companies, even within the same sectors or industries. You're seeing a lot of differentiation in terms of how management is handling higher prices, higher wages, more headwinds thrown at them. So certainly it is a time to pick and choose which managers and which management of companies are doing the right things in this environment.
Mira, thank you. It's good to see you. Mira Pandit there of JP Morgan Asset Management. Just some breaking news in the last 10 minutes or so. I want to share that with you. The SEC charging 11 Wall Street firms with failures around record keeping. There's a range of fines here. I'll share some of them with you. Wells Fargo agreeing to pay a $125 million penalty. BNP Paribas, $35 million. BMO, Mizuho, each paying $25 million. Goes on and on and on from there. This is the line that stands out, and this is what it really is about. So, as described in the SEC's orders, and this is direct from their press release, Tom, the firms admitted that from at least 2019, their employees often communicated through various messaging platforms on their personal devices, including iMessage, WhatsApp, and Signal, about the business of their employers. The firms did not maintain or preserve the substantial majority of those off-channel communications in violation of the federal securities laws. So 11 Wall Street firms charged by the SEC on a failure of adequate record keeping, Tom. The fines themselves, though, not large for banks, though.
I agree.
10, 20, 30, 50 million?
Well, but the sum of it's 289 million, I believe is the number that I've got here. The font's a little small. 289 million is the all-in sum. I don't know if that's big or small, but this is an intractable problem, and Bloomberg has tried to deal with this with our IB. And you know, IB is within the system, and you can keep the records in that. WhatsApp, or what are we calling a repost? If you do a repost, on X off of the 42,000 shares of Apple you just sold, how do you keep that record?
This directly goes to working from home, too. If you think about what happened during the pandemic and everybody using their own modes of communication, what does the bank that they work for have to regulate, oversee? How much do they have to turn over their phone, their texts, et cetera, to a bank that now is responsible for it? And this was a shot across a bow. And there are going to be a lot of real conversations about that.
Solution: when the market closes, you leave your phone at work and you leave, and no one can contact you.
That's not what we do.
That's what we should
You're
do.
right. No,
not even just for traders. That's everybody.
Seriously,
exactly.
John, there's people that want to do that, but that's not the new world.
That's not the new world.
No,
Did you see that Zoom have told their employees to come back to the office?
That's hilarious.
I saw that.
Yeah, Zoom video communications. They're basically saying we need more people in here. Hybrid work, but do a little bit more.
Zoom's doing
never done Zoom.
Exactly.
Come on, never did Zoom.
Never done Zoom.
I don't think I've got an account with Zoom either. It was never. No.
Seriously?
No. You could download the app and someone would send me a meeting and I would use it, but I never had.
The video on? You're one of those people.
I never Zoomed.
Just, I might have been there, might not have been there.
Yeah, you're one of those people.
I'm one of those people.
I'm on the camera.
Is that a bad thing? One of those people.
Well, it's like the people who kind of want to hide some of their emotions, et cetera, which is like,
here we go.
Like on a Zoom call. That's always kind of like the group
You're
chat.
accusing Tom and I of hiding our emotions.
Yeah, you guys actually share plenty, but I am wondering whether, there is going to be a shift away from Zoom. I find Zoom annoying because of the delay.
Okay. If you're just tuning in, welcome. Equity futures right now on the S&P, negative 0.8%. Stephen Stanley's coming up, 8:30 Eastern Time, about 17 minutes away. Chief US economist over at Santander US Capital Markets. Tom, on the labour market and on the inflation data still ahead this week.
The price data front and center here with the deflation out of China today. Elements of disinflation, as Rob Waldner said, the idea here of nominal GDP coming in. That's a good time to address that with Mr. Stanley.
With the bond market that's running hard, Lisa, and yields are lower by something like 10 basis points. This market, selling off this morning, can't really identify one single piece of information, Lisa, that's driving it. Tom mentioned the trade data out of China, the inflationary story later this week, the downgrades of US banks by Moody's. Take your pick.
How much are we going to start focusing on regional banks again? Do we have to care about that again? Are people going to be talking about the SLUs and actually caring about senior loan officer opinion survey?
Moody's turned up the volume a little bit. Just turn the dial, just a touch. We're talking about it. So we're talking about it again after not talking about it for 3 months, when that's all we talked about through March and into April.
Exactly, but that's my point. Do we start to care a little bit more?
I'm with you.
I don't know.
Equities down from New York. Good morning.
We are basically overdue for a 3 to 5% pullback. It would be normal. And believe it or not, we are now running in, 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback. As I said, that's pretty normal.
Vicky Chadha at Deutsche Bank on the wobble in this market. There's a wobble right now. Equities Near session lows on the S&P 500, negative by 0.8%. A rally in the bond market, yields lower by 9 basis points. Commodities softer, crude to $80. We're down about 2.2% on WTI off the back of weaker than expected trade numbers out of China this morning. Downgrade to the banks out of Moody, 10 of them, small to medium size here in the United States, talking about risks around commercial real estate and all of the above. In the FX market, dollar stronger, just capturing that risk-off tone, that risk aversion right the way through. Cross-asset in this market, the euro back down to about 109.40, euro dollar negative 0.5%, even with the dovish tones of Patrick Harker, who is a voting member of the FOMC, Philadelphia Fed president speaking, saying the Fed will need to hold rates steady for a while. We might be at the point, though, where it can hold rates steady. And with this, Tom, the US economy is on a flight path to a soft landing, saying all the right things there. Some dovish tones coming out of Philadelphia this morning.
Before the inflation report, what is it, in 2 days? I mean, you're getting an inflation
Thursday.
report in 2 days, and we'll get another one before the Fed meeting, and they're slaves to the data. That's all there is to it.
Yep.
I don't know what else to say, and part of it was the data out of China today. It was shocking.
Are they slaves to that?
Yes, I think so on a global basis. Jerome Powell is, in honor of Bill Rhodes, central banker to the world.
Whether he wants to be or not, I guess.
He doesn't have a choice. That's the way it is. What we're going to do is dive in now with expertise at Bloomberg Intelligence. Long ago and far away, you did what you could to steal the research of Prudential Research and one Lee Klasko. He was read worldwide and across this nation on boring stuff like trucking and railroads in this strange word, logistics. He's senior logistics analyst for Bloomberg Intelligence. It's a gift we have him today. I'm going to conflate in here the bankruptcy of Yellow with what we see in UPS. Given these events, can they raise rates? Can they raise and sustain revenues by raising rates?
Yeah, I mean, that's what UPS is going to have to do. And they do have pricing power because at the end of the day, there's really two main competitors. It's UPS, FedEx, obviously the U.S. Postal Service, or some smaller players. But they have the ability to raise rates. And not only can they raise rates, but they're also going into markets that are more profitable for them. So they're going to the small and mid-sized shipper versus the big enterprise shipper. So they're kind of pivoting away from the Amazons of the world, if you will, and going, kind of down market, because those customers tend to be more profitable, and they're going into more profitable verticals like healthcare, which tends to make more money for these.
You don't do buy, hold, sell, John, but to me, you wonder if it's just like back up the truck and load the boat.
I'm not about to do a buy, hold, or sell on that name either.
You back up the brown truck and load the boat right here.
Can we bring in the volume story into the conversation and just talk to me about what's happening domestically in America? Because we're hearing from some domestic-focused airlines, for instance, JetBlue, Southwest, mentioning that maybe things aren't as great as people are saying. What are we learning about the domestic U.S. economy from this company?
Well, we've been in a freight recession for quite some time, and that's really driven because everything's being normalized, right? We're recalibrating back to where we used to be before the pandemic. So freight is declining. So what we're seeing is what we view as kind of like the bottom of that, and there's been a lot of destocking by retailers, and we're pretty optimistic that you're going to see some sort of seasonal uptick into the fourth quarter. We're not calling a huge peak season, but last year there was no peak. We think there's like maybe a slight speed bump of a peak this year. And what's that telling us is that the consumer is still resilient, and things should look better for UPS or a FedEx into 2024 on a volume standpoint. You have that plus pricing, you have that plus productivity improvements from tech. It's hopefully going to offset some of the increase that they got in cost from that new labor agreement with the Teamsters.
So how significant was that? I mean, that was really my question. Is that a smokescreen, this whole agreement with the Teamsters, to cover some real fundamental weakness that they're facing or competition? Or is this truly going to create a challenge to their profits going forward in a more material way?
It's definitely going to challenge things, but what I would say is that in the second quarter, the second quarter, that's a has-been quarter, they did a fantastic job. I mean, they beat by 4 cents in EPS, and it was all on margins. It wasn't on pricing. It wasn't on volumes. They actually disappointed. So they disappointed on the top line, and they surprised on the upside on the EPS, and that was real on margins. Their domestic business was, it was about 130 basis points better than expectations, and it was only 30 basis points less than what people were thinking.
If they can absorb it, what's the message to other logistics companies, to other trucking, shipping, flying companies that are also facing some organized complaints about the lack of wage growth, the lack of pass-through of some of their profits to the employees.
Yeah, at the end of the day, labor is increasing, and we're not going back to a 2017, 2018, 2019 level. So, if you're a truckload carrier, you had to increase what you paid your drivers. Rates have gone down considerably, and so what that's doing is forcing a lot of smaller companies out of the market, and that will firm up rates and bring rates back up. And so the Knight Swifts of the world will have much better margins in the coming quarters. So
with higher prices.
With higher prices. Right now, the truckload market is terrible. Like the spot market is pretty much bottoming. We should probably start seeing increase in spot rates into fourth quarter, and contract rates are down by low double digits. And we expect that to kind of invert positively in 2024 to see maybe mid-single digit truckload rate increases on the contractual side.
If there was high single digit, even double digit revenue growth, and that reverts back to mid-single digit, low single-digit revenue growth, the slog of logistics, if you will, can they sustain a given margin down the income statement?
Really depends on what subsegment of the market you're talking about. The less than truckload market where Yellow filed bankruptcy, that's a very consolidated market, so they have pricing power. FedEx, UPS, they have pricing power. Railroads, they have pricing power. Truckload carriers, not so much because it's extremely fragmented. So it really depends on what market you're in, whether or not you have the pricing power and whether or not you can push those higher costs onto your consumers.
Lee, this was great. It's good to see you. Come back soon.
I will.
Lee Klasko there of Bloomberg Intelligence. Thank you very much. Just want to go back over that Fed speak from around about 5 minutes ago. This was from Patrick Harker, Philadelphia Fed president, signaling we might be at the point where we can hold rates steady and no longer increase interest rates. The Fed would need to hold rates steady for a while, he says. The US economy is on a flight path towards a soft landing. We know that Mr. Klanovic over at JP Morgan, based on his recent communication, disagrees with that view. But this is a couple of voting members of the FOMC, regional Fed presidents, over the last week, Goolsbee of Chicago, Harker of Philadelphia, Lisa making a point that we might be at that point where we can wait.
And they're being incredibly cautious about it, right? They are realizing that saying it's going to be a soft landing could set them up for some ridicule. I do see us on the flight path to soft landing. This is Patrick Harker, that we all hope for, and that has proved quite elusive in the past, basically recognizing that this is a high hope. And yet, doesn't it seem like the threshold for them to hike further seems higher and higher and higher?
The difficulty they have is how do you signal that we might be done without risking a premature easing of financial conditions, Tom, which leads to a reacceleration of inflation. That's going to be the nervousness around communicating this.
That nervousness is embedded in economic academics. Austin Goolsbee's expert at this, just as, with all of his work at Chicago. And the answer is pick a bank. In my case, it's Bank of Japan. I'm going to guess 18 years ago, whatever it was. They raised rates. They were wrong. Oops, they had to cut rates again. That is the embedded fear of every central bank out there, which is one reason for Chairman Powell at Jackson Hole to cut it down to a 7-minute speech.
About nothing.
First do no harm is where he is right now.
We're on the same page on that, that's for sure. Mike McKee's going to drop by and get you all up to speed on the latest Fed speak and on the data as well. Coming up on the Open in the next hour, Mike Collins of PGIM, Kelsey Berrow of JP Morgan on the bond market, David Bianco of DWS Group on this equity market. With equity futures down 0.8%, the bond market rallying, yields lower by more than 10 basis points on a 10-year, and the dollar stronger. The euro 109.42 from New York. This is Bloomberg.
Bloomberg surveillance markets on the move. We've seen it all morning. Equities, bonds, currencies, commodities coming off the China news and disinflation, outright deflation tone across the tape. And Lisa, to be very clear here, it deteriorates into this Tuesday morning.
There's a jitteriness as people parse through what we saw out of China, this idea of a real retracement of an economy suffering from long economic COVID. And we get the trade data from the U.S. currently.
Moments ago, oil, American oil, under $80 a barrel, $79.95. With our trade balance review, Michael McKee, Bloomberg trade balance China correspondent. London.
This just into the Eyewitness Newsroom. Trade balance for the month of June, the final number comes in at negative 65.5 trade deficit of $65.5 billion. That is down from a revised 68.3 in the month of May. It's actually good news as the trade deficit shrinks in terms of GDP growth. The exports number comes in down just a tenth and imports down 1%. Steve Stanley coming up, he can tell you what all this means for a revision to second quarter GDP, but we had seen the initial number add about 0.1% to that second quarter GDP. Interesting, we have seen in recent weeks various people, including the folks at ISM Manufacturing, the companies they surveyed, saying that both import and export orders were down. They've been down for a number of months as we, I guess, work off inventories. And so that's having an effect on the overall economy at this point.
Is global trade down? On an IMF aggregate basis, OECD basis, is global trade dampened?
It is somewhat, and we're seeing that play out in a lot of places. Obviously, China, with its data this morning, Germany is seeing its trade numbers deteriorate. So overall, the reshoring effort seems to be having, well, you got to separate that. You don't know whether it's just economic weakness or whether it's the whole reshoring thing.
How similar versus different is the story in the U.S. from China, where you saw an actual increase, as you pointed out, in exports, not necessarily that kind of retracement that you would expect based on what we saw out of China?
Well, it is interesting because the Chinese are going in a direction that we have gone for many years and now have gone the other way. Our economy is stronger. Consumer demand is much stronger than in China. And at this point, they're looking for ways to stimulate, and it hasn't really helped.
Michael McKee, stay with us. This is important. And this is a joy for all of Bloomberg surveillance in the umpteen years that I have been at Bloomberg. Because someone we know, John, has just gotten a job promotion. He's going to become chief camp counselor here in the summer. And it is John Rogers at Goldman Sachs. He with the State Department credit, and of course, chief of staff at Goldman Sachs, and all of the Goldman Sachs philanthropy will step aside. And Michael McKee, Russell Horowitz will take over. He worked with Arthur Levitt at the Securities and Exchange Commission, worked within a Democratic administration at the White House, and he will take over. You and I know Russell well from his work at Bloomberg News years ago.
Yeah, he worked with a lot of famous, important people, including you and I.
He was instrumental in me coming to the company. It was very kind. It's good to see Russell Horowitz will advance to that important chief of staff position at one of our venerable firms. We'll move on from there. Lisa, the market, I don't see much action off dated trade balance. Boy, that's going to be different on Thursday with the inflation report.
And it's going to be different potentially at 1 p.m. after we get the auctions of U.S. Treasuries. We're going to get the first of 3 sets of auctions today with $42 billion of 3-year notes being sold at 1.
It's going to be interesting. Stephen Stanley joins us right now, Santander, chief U.S. economist, to do the math. Does trade balance math that dated? Does it change? Like, are you sitting there as Mike reports that, moving numbers in your head about what the trend will be?
No, because the data is so volatile from one month to the next that it rarely gives us a clear view of the trend. I think in general, just to the discussion you guys were having before, it's worth remembering too that, and this is a global phenomenon related to COVID, that all the economies around the world are kind of shifting back towards services and away from goods. So I think that probably weighs on the trade flows as well.
We had a bond expert come in today and say nominal GDP is coming in. We're going to see real GDP challenged, and that inflation dynamic is going to come down as well. Where's nominal GDP, the animal spirit of the nation, 1 year out?
Yeah, I think it's probably going to be down quite a bit, but still significantly positive. I mean, we've been waiting and waiting for this recession that the consensus has been calling for, and it just hasn't happened. I think there's a better chance of it in 24, but I think the economy probably is able to muddle through. Nominal GDP next year probably between 3 and 4%.
One of the key questions is the muddle-through economy. Does that leave inflation higher on the other end? Are you in the camp that it does?
Well, I think the Fed has the power to get inflation back to 2%. It's just a matter of whether they're going to do what they need to do, and are they prepared to take whatever pain that brings with it. So far, we've gotten a good bit of disinflation without really a lot of pain on the real economy side. And the Fed, of course, hopes that continues, but we'll have to see about that.
Well, we just heard this morning from Patrick Harker of Philadelphia saying the same kind of thing that we heard from some of his compatriots, that the soft landing is kind of elusive, but it looks kind of like we're getting close. And then all of a sudden, the Treasury supply comes into focus. How closely are you watching the Treasury auctions, not just today, the 3-year, but tomorrow, the 10-year, and the day after, 30-year, to understand what the yield dynamic will be going out?
Right. No, I think the supply thing is one of the most overrated forces on interest rates historically. Typically, people talk about, oh my gosh, we got these big budget deficits, and it almost never seems to have a real impact on yields. But this is an example where it has, and I think there's a reason for that, which is that the fiscal situation is in really bad shape. Typically, when the deficits are rising, it's because the economy's weak, and so if you just look at the correlation, high deficits are correlated with low interest rates because the economy is typically weak. What we've had over the last 5 to 10 years, if you kind of filter out for COVID, is the deficit is rising on a trend basis at a time when the economy is doing okay.
In your study of the American economy, can you comfortably aggregate statistics now, or do you have to take a more disaggregated approach? Because even if we have a slowdown of some type, there's part of America, the haves, that are doing so great, technologically advanced, blah, 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 but there's another part being left behind. Do you disaggregate, or can you sum together?
I think it's a lot easier to disaggregate now because there's so much more data, and the data is available on a more detailed basis, and it does help, I think. The current situation is actually a great example of that, where everybody, the question is always, are we in a recession? Are we going to have a recession? But then you look at different parts of the economy. Housing has been in a recession, or was in a recession in the second half of last year, and arguably has already, bottomed out. Manufacturing, I would argue, is in a recession right now. The consumer is definitely not. So when we ask, is the economy in a recession, I think it's, to your point about disaggregating, it's better to kind of look under the surface at various sectors.
So what's your real GDP, nominal GDP call out 12 months? Just quickly, what are those numbers?
So I've got real GDP running around 1%.
That low?
Middle of next year, yeah.
Okay, well, this is important. You got a 1% U.S. economy. What portion of people with a 1% economy, I believe that's not a recession, baloney. What percentage of America feels like a 1% real GDP is a recession? I would say it's substantial.
Well, it depends on how the labor market responds. And we've had slow growth for a while, and the labor market has stayed strong. I think companies are to some degree maybe hoarding labor, given how hard it was to find people during the pandemic. This is the dream of Chairman Powell and those at the Fed, that they can get growth down enough to bring inflation down without seeing a big jump in the unemployment rate. Again, so far so good, but we're certainly not out of the woods yet on that one. But really, I think when you talk about people feeling a recession, how they feel it is they lose their jobs.
We've seen one economist after another come out and say, all right, maybe we're not going to get recession this year, maybe even not next year. We're going to push that out, or maybe just take it off the table. Are you in the same camp? Is there anything that you're sort of reassessing after the slew of stronger than expected data that we've gotten so far?
Yeah, I was always more optimistic than the consensus for this year. And a big part of my thought process was that consumers were sitting on a tremendous amount of liquidity left over from the pandemic. The labor market was going to be healthy enough to support good income growth. And I think that has borne out. The question is what happens once consumers have spent down most of that cushion and the full effect of Fed hikes has passed through into the economy, which is why I'm a little more worried about 2024. I mean, my base case is that we do kind of muddle through, but I think if we're going to get a recession, I've always felt it was more likely in 2024 than this year.
You said that it is important to watch what the Fed does to make sure that they have the conviction to bring inflation back to the 2% target. Based on the rhetoric that you've heard so far, do you have that confidence?
I do. I think they definitely were late beginning the tightening, but you have to be impressed with how forceful they've been since March of last year. Whether they stop here or go another 25 or another 50 is less important than having the conviction to stay at a restrictive level until they get the job done. And I think that it seems like there's a whether you're talking about hawks or doves on the committee right now, it seems like everybody's on that page.
Steve Stanley, thank you so much for the update. We look forward to stealing your literature here in the next couple of days. He's with Santander. He'll make adjustments as well. Futures negative 32. It's a little bit of a bounce off the agony of the last hour. Dow futures negative 255, above 35,000 on the Dow. The VIX out to stick, 16.90. A little bit of tensions there. 30-year bond, Lisa, we've had to medicate her to get through the morning. 11 basis points in 30-year. I can't even, I'm gasping. I loaded the boat on the 30-year yesterday. Look how that worked out.
Well, that's actually a positive. If you see the yields come in, you loaded the boat. That's actually a good thing, right? Because yields are coming in so significantly. The concern that people have at this point is how many people are going to come in. And we've heard from Rob Waldner saying he's buying. He actually sees this as a great time to lock an opportunity. We were hearing from Mira Patel of over at JP Morgan Asset Management. Yeah. Similarly, are we in the same kind of zone where suddenly people are saying lock in 4% yields over 10 years looks pretty good because we're not going back to a new normal where yields and inflation is going to be materially higher?
The polarities, if you've been great about the polarities, have been just absolutely extraordinary. And the answer is if you get a Stephen Stanley nominal real GDP or an Ed Hyman nominal or real GDP, that's where Rob Waldner's saying you get a 4% 10-year, and then you bring it in lower from there.
And Mira Pandit over at JP Morgan Asset Management
that's price up, yield
thing.
down.
Thank you. That's very good. Excellent.
That. Yes. John Writing taught me
that. That's excellent.
Only one that taught me. Let me do a data check here. We need to do that within all going on in the markets. Dollar stronger and nicely stronger, I should say. Euro well under 110, a 109.47. Equity markets, Standard & Poor's down 0.7%.
Tom, you mentioned this story out of Goldman Sachs, Dealbook reporting that John Rogers, who has been chief of staff, handing his role to Russell Horowitz, a compatriot of yours and of Michael McKee's. What I think is interesting here is this comes amid the slew of departures that we keep reporting, this sort of overhaul. And in this column, it talks about how David Solomon is conducting an overhaul of the bank. And I don't know what the connection is to some of the departures, but it is interesting to see that the key strategist is also having a changing of hands.
I don't know the story on John Rogers, and maybe Shonali Basak and others, Sri Natarajan, can give us some insight here. But I would say within a large firm like this, you have staff, operations, people doing speech writing, scheduling, which event. I got 5 events to go to. Which one is the one of best value to the firm? That's what John Rogers brought to the table, as well as all of the philanthropic work that Goldman Sachs does. John Rogers provided huge leadership there.
So John Rogers, according to Dealbook, who is 67 years old, is not leaving the company. He is going to retain other positions at Goldman, whether it's vice president, secretary to the board, et cetera. So he still will play some roles. It's more.
He could spearhead their ownership of the New York Yankees, which is needed right now.
Is that what you're suggesting right now?
Is that
an
John
open
Rogers
invitation?
could take his time to do that, yes.
You think that he'd be a good leader, good manager?
Well, I think he could spearhead the effort for a busy Goldman Sachs.
Are you trying to foster the Yankees' prowess based
on
the Red Sox performance?
Well, the Red
Where's
Sox
your allegiance?
My allegiance is they're both in last place is my allegiance. Stay with us here. We got some real churn in the market here this morning. And again, Russell Horowitz to be the new chief of staff at Goldman Sachs after his tenure years ago at Bloomberg News. Please stay with us worldwide, Bloomberg Radio and Bloomberg Television. Good morning.
I think the most important thing that happened this year in Bitcoin is Larry Fink. He got orange pilled, as we say. Orange pill is when you take a non-believer and you make him a believer in Bitcoin. And Larry was a non-believer, and now he says, hey, this is going to be a global currency. People around the world all trust.
Novogratz. There's no other way to put it. He is Novogratz. Mike Novogratz, Galaxy Digital founder and CEO, which barely describes his interesting career across Wall Street. He is someone that's been out front on Bitcoin and continues to advocate for Bitcoin. That is part of an important conversation with David Rubenstein, Bloomberg Wealth, tonight at 9 p.m., and, of course, all of the Bloomberg Digital media. Lisa Abramowicz and Tom Keene, thrilled that David Rubenstein could join us this morning. This is perfectly timed because Novogratz has been the piñata of Bitcoin when it goes down. It's been the genius of Bitcoin when it goes up. And all of a sudden, Larry showed up at the door to say, hey, big, respectable firms can prosecute and do Bitcoin. Link Lawrence Fink of BlackRock to Mike Novogratz.
Well, what's happened is people, as you suggest, make fun of Bitcoin and other cryptocurrencies, but now the establishment, Larry Fink at BlackRock, is now saying they're going to have an ETF, if approved by the government, in Bitcoin. So you're saying, wait a second, if the mighty BlackRock is willing to have an ETF in Bitcoin, maybe Bitcoin's going to be around for a while.
Lisa wants to jump in here, but I'm going to cut to the news moment. Is Carlyle announcing this morning a Bitcoin advocacy?
No, I don't think so. But there's no doubt that Bitcoin is something that I wish I had bought it at $100 a Bitcoin when Mike Novogratz started buying it. It's now at $29,000. So he's made a lot of money. And a lot of people who bought it at the $100 or less are feeling pretty good. Now, it went up as high as $61,000, I think. Even down to $31,000 or even $29,000 now is still a pretty good profit if you bought it at $100.
We all wish we would have bought it at 100 and to ride it up. It's one thing for BlackRock to come up with an ETF because they believe in the proposition of Bitcoin. It's another because they see a profitability proposition where they can, basically take advantage of the interests other people have. I mean, isn't that more of what this is? That basically Wall Street is saying if there is a market for it and we can viably make one for them and make some money, why not?
Well, remember, Wall Street is in business to make money, and this is something they can probably make money of. You have to remember, the United States government has been somewhat skeptical of it. I think Democrats in the Congress, and particularly the people regulating the SEC, are skeptical of Bitcoin and other cryptocurrencies. But outside the United States, there's a lot of interest in it. I think FTX really hurt when it went bankrupt, and it hurt the crypto industry. But a lot of people around the world want to be able to trade in a currency that their government can't know what they have, and they want to be able to move it around, rightly or wrongly. And so I don't think Bitcoin is going away. And I think the Republicans on Capitol Hill have been pretty supportive of it.
There's a difference between having a seamless cross-currency payment, basically saying that instead of going to Western Union, I can go and just transfer something in Bitcoin if it has a stable enough price. That's one proposition. But the proposition of Bitcoin as a store of value that could kind of be bid up the way that gold or silver could seems to have been parked with the advent of yield suddenly that you can get for actual money. I mean, isn't that sort of the feeling that you're getting?
Well, there's no doubt that when interest rates are as high as they are, you don't need to have gold or other kinds of things to get you some solid return, because when you get 5% on treasuries, but eventually 5% will be coming down at some point. I don't think Bitcoin or cryptocurrencies that are the better ones, the better known ones, Bitcoin and so a number of others, are going to go away. There's enormous interest around the world in being able to have something you can transfer without the government knowing about it and keep it private. And, you can say people shouldn't do that, but that's not going to stop people from doing it.
Mr. Novogratz on Mr. Gensler. What did you say about the efforts of our chairman of the Securities and Exchange Commission?
Well, Gary Gensler, who's the chairman of the SEC, is not a big fan of cryptocurrencies. I think that's fair to say. But he lost a major case recently in court where he was trying to argue that one of the cryptocurrencies, Ripple, was a security, and he lost that case. So I think the SEC has not been able to convince at least the government yet, or at least the courts, that cryptocurrency is such a dangerous thing. And I remember a lot of people in the government now are thinking that Gary Gensler won't be the chairman of the SEC forever.
That's where I wanted to go. I mean, these guys just wait him out, right?
I think that's a strategy that's very popular in Washington, waiting out regulators you don't like.
And that seems to be something that has worked given some of the turnover that we've seen. I want to shift gears a little bit because we've been talking all week about banks losing talent to your world, to private equity, and to the sphere of private debt and equity that has continued to take more and more market share. Have you seen that accelerate recently as people really take a look at what they can earn and the potential opportunities in your world?
There's no doubt that some of the large investment banks, like Goldman Sachs and others, but not just Goldman Sachs, have people leaving. But that's actually relatively normal. People leave all these firms all the time. After people typically retire from Goldman in their early 50s, whereas a regular kind of job, you might retire in your 60s. So I don't think it's that unusual right now. And I think Goldman's obviously got a deep bench. I think it's in pretty good shape. But there's no doubt that people think that in private equity, if you do well, you can make more money than you can in investment banking. That's generally been accepted for the last 10, 20, 30 years or so.
Do you think that that's going to get pressured at all as there is more competition and, frankly, in the higher yield environment, and if there is some sort of default cycle and a little bit of stress?
Well, remember, in private equity, it's harder to do private equity deals typically today because interest rates are higher, harder to borrow and so forth. But that gives people more opportunities to buy things in the distressed debt area. So there's always people who want to buy things at some kind of value chain proposition. And right now, there's a lot of view that you can buy things relatively cheaply, probably in the near future, in distressed real estate or other kinds of areas. So I don't think all of a sudden people that want to be investors are going to say there's no opportunity.
In what you're doing at Carlyle with your team, is there malinvestment in AI right now? Is there a frenzy going on where dumb decisions are being made?
Well, I don't want to speak for Carlyle. I would just say generally, AI has caught attention and people are putting money into it. Whether you're going to make a good return on that money, I don't know. There's a conventional view that the best way to invest in AI is investing in the large companies like Google, Microsoft, and so forth. Other people say you should go find the next startup of OpenAI. I don't really know which is going to prevail, but there's no doubt that people are putting money into AI, and they will for some time.
I want to just pick up on one thing that you said, that in the near future there's going to be a good amount of distress, particularly in some real estate areas. Where are you talking about in particular?
Well, I don't think it's a secret that in the commercial real estate office market in major cities, New York, San Francisco, among others, people are not coming into offices, and therefore employers are thinking, I don't need as much office space as I once thought I did. And also, because interest rates are higher, the value of buildings goes down. There's an inverse relationship. So if interest rates are high and the value of real estate goes down and people don't need as much real estate as they did before, and then they renew their leases, they're going to take less space, it's probably going to mean the value of these buildings is going to come down.
How concerned are you about New York City?
Well, people have been concerned about New York City for the last 200 years or so. For 200 years, people always say New York City is going to fall apart, and for 200 years it survived. So I got a lot of things I'm worried about, but New York City is not number one.
David, thank you so much. David Rubenstein with us here. Really interesting conversation and timely conversation with Michael Novogratz. Look for that on Bloomberg Wealth tonight at 9 p.m. Lisa, what a day. I guess we got some stability in the tape with the futures at -30, down 0.7%. I mean, this China news began narratives that really shook up the market today.
And we are getting some Fed speak. We were talking about Patrick Harker earlier, talking about how it was likely that we could potentially see the Fed hold rates here for a longer period of time, and that maybe we're getting that soft landing. Nobody really wants to say that with any conviction. And we're hearing from Tom Barkin of the Richmond Fed saying that inflation still remains too high. This is pretty much consensus, that GDP remains solid, labor market remarkably resilient, not necessarily tipping his hat that much, but people trying to read the tea leaves. How much conviction do they have to actually get inflation back down to 2%?
You know this. I'm afraid to ask. Is there another Fed speaker today?
Not today.
Coming up?
Not today.
We're done with the pain here of crystal ball gazing.
It's important because there's a question about whether they're going to accept a 2.5%, 3% inflation rate. And if that is the case, that could have a material effect on where people are going to set their rates.
Some disinversion going on. Forget about the vanilla spread 2s, 10s. The answer is 2s, 30s. We've really disinverted here. I mean, there's some real dynamics going on in the yield space.
I'm watching 1 p.m. I really think that this is going to be interesting. It'll be a complete non-story. We will not talk about it tomorrow if it is really smooth and if you get a lot of bids in it. But we'll talk about it nonetheless because it's a 10-year auction tomorrow. To me, who's going to step in? Are there going to be enough people buying?
What's the one thing at 1:10 p.m. I should read of those nuances in auction processes?
How much the dealers took down, how much there was indirect buying, and just where the yield is before and where the yield is after, just as simple as that.
Your auction analysis with Lisa Abramowicz.
Thrilling morning
futures
television.
-31, Dow futures -245. It's like watching varnish dry as well. Up a stick. You know where I am on this, folks, the auctions. Somehow the United States of America will get it done. 16.87. On the VIX. In oil, a nice pullback. West Texas Intermediate with a 79 print earlier, $80.38 on American oil. Brent crude under $84 a barrel as well. We're watching stronger dollar this morning. This is Bloomberg Surveillance.